Welcome to the Complete Beginner's Day Trading course for 2026. If you're just getting started with trading or you're struggling to find consistency, then this video is for you. This is going to be my most in-depth, full, free beginner's course that I've ever made. I'm putting everything that you need to know from A to Z on becoming a day trader from scratch as a complete beginner in this video. If you don't know me, my name is Preston, but everyone online calls me PB. I've been trading for over 6 years now, and it took me 2.5 years to finally become consistent. I was lost. I was going from strategy to strategy. I was blowing accounts, losing money, and I just felt hopeless. But then I decided to simplify trading, go all in on one system, and I stuck to it religiously. And as a result of that, I achieved everything that I wanted. I've spent years creating content and teaching traders online. And in this video, I'm putting everything that I wish I had when I was a beginner into it. This free course is a result of all the experience I've had and everything that I had to go through to become a consistent trader. I'm going to be going over risk management, mindset, psychology, strategy, entries, exits, making a plan, how to find stocks to trade, how to pick the correct options, how to set up your trading account, literally everything. My goal is to give you a fast track to profitability and help you avoid all the mistakes that most traders make. This isn't like getting rich quick. Trading is a very hard skill to learn, and like any other skill, it takes a lot of practice, time, and process. So if you're finally ready to take trading serious and get a step-by-step roadmap to becoming profitable in 2026, let's get straight into it. Disclaimer, trading is not a get-rich-quick scheme. Trading is extremely hard. This video is only for educational purposes. None of this is financial advice. Trading is extremely risky and only risk money you could afford to lose. First things first, guys. What do we trade? We trade options. So that's what I trade. I trade options. And you may ask, okay, PB, so what's the difference between stocks and options? Stocks are shares. So you're buying one share of the company goes up 1%, you make 1% of your money with stocks. Options are leveraged contracts of the company. So that means options are leveraged contracts of the company. So for example, say that a stock goes up 1%. If you were to buy a share, then you make 1% of your money. But if you were to buy an option, you can make 50 or 100% of your money. You can double your money instead of making 1%. So this is why options are key for growing small accounts or in general growing your account. Because look, the truth is it's really hard to grow an account in the short term with just trading shares. It is really, really hard, especially trading larger names like we do. But with options, you have that leverage. So you can make 30, 40, 50, 60, 100% a day compared to 1 or 2% with stocks. This is why we like to trade small accounts with options. And in general, accounts you want to grow. Options were literally like, the whole point of trading options is to risk a little to make a lot. But with that, it comes more volatility, more risk, and more stress. So I want to basically go over first off, the basics of options, how options move, and then I want to go over what options are you supposed to buy. So, there's two types of options. There's calls and there's puts. So, as you can see, when you go to a trading broker, you have the option to buy calls or your option to buy puts right here. Calls means you think the stock's going to go up. If you buy a call, that means you're betting the stock is going to go up. So calls, up. Puts, you're betting the stock's going to go down. That's the beauty of options, is you can make money when the stock goes up or you can make money when the stock goes down. I love trading when the stock goes down. Puts are my favorite. So, next, there's a certain way that options move. These are called the Greeks. Option Greeks. This is how you know how options are going to move. There's three main things with Greeks. There's delta, there's gamma, and then there's theta. These two are less important. I don't really look at them, but Vega and Rho if you want to do some research. So this might sound a little bit confusing, guys, but just stay with me. Delta is the underlying estimated move of how much an options contract will move based on every $1 move up or down. So For example, say the option contract's at $2, and the delta is at 50 cents. That means if the stock goes up $1, then the option will go to $2.50. So let me show you guys. Stock, it's at, say, 100, and it moves to 101, right? The delta is 50 cents. The option is at $2. So because the stock went from 100 to 101, that's a $1 move up in the stock. The delta, this is how much gets added to your contract every $1 move up or down. So that means at the end of this move, your contract will be $2.50. Okay, guys, so say the option is at $1. $1. And the stock goes from 100 to 101. That means the stock went up $1. The option then goes from $1 to 150. So here, if you were to put $100 in, you would have made $1. You would have made $1. With the option, you would have made $50. $50. That's why we love options. You could risk a little to make a lot. Gamma then basically tells you like the delta's expected rate of change. So for example, every $1 move up or down, if the gamma's 10 cents, then for every dollar move up, so now the delta then goes from 0.60 to from 0.50 to 0.60. So plus 0.10. So that means the next dollar, if the stock then goes to 102, then your contract's going to be worth $2.10. And theta is just time decay. So you don't really need to worry about this if you're holding these overnight. It basically tells you that no matter what, the option is losing this much in value at the beginning of the next morning before you add a delta. So now that you know how options move, let's go over how do you know which options to buy. So guys, this is really important. So we're here at SPY. This is what your options are going to look like. You're going to have calls, puts, strike, the expiration. So let's break every single column down. Mid, this is the price of the contract, okay? Mid, this is the price of the contract. 11 March 24, this is the expiration date of your contract. Percent change, this is how much your contract has changed in the last day. Last, this is the last price of your contract, the last traded price of your contract. Ask, this is how much you can buy the contract for right now. Bid, this is what you can bid for it. So bid is what people are bidding to buy the contracts at. Ask, or what people are trying to sell the contracts at. Strike, this is your strike price. This is what you want the stock to eventually get to. So for example, SPY, if it's at 511.72, you may say, okay, PB, I don't get it. So which call am I buying? How do I know what to buy? Okay, stock's at 511.72. We want to do slightly out the money contracts. What does that mean? That means the SPY's at 511.72. Then what's out the money? 512. Why? Because it's 30 cents away. It hasn't got to 512 yet. It's at 511.72, right? So then, once you know that it's at 511.72, you would say, okay, if I'm going to buy calls, I'm going to buy 512 calls, and I'm going to buy the closest expiration that I could buy. Okay? So that's how I do it. So for example, for you guys watching it, it's going to be probably January 1st, right? That means that I'm going to trade, okay, well, January 1st market's closed. So say it's January 2nd and you want to trade, right? That means that you're going to buy January 2nd contracts, or you could do January 3rd contracts. On SPY and QQQ, the expiration date, so the expiration date of your contracts are every day. On every other stock, it's every Friday, okay? So we're buying the closest expiration, and you may ask, like, PB, I don't get it. What's the closest expiration? All this stuff, right? Let me show you. So this is Microsoft today. You guys see all these expiration dates, right? There's December 27th, January 3rd, January 10th, January 17th, all these expirations. We're buying the closest one. So in the morning today, I was doing December 27th. If it's Monday, then what's the closest one? January 3rd. The closest one, and if I'm buying calls, then I'm doing the closest ones out the money. So I'm buying 512 calls for SPY. If I'm doing puts, then I'm doing 510 puts because I want to catch these from out the money to in the money. Here's why. So say in SPY, I wanted to buy 512 calls, right? 512 calls. And the stock's at 511. This is how the contracts are going to move. They're going to move. So SPY goes up, contract goes down. SPY goes down a little, the contract goes down a lot. SPY goes up a little, contract goes up. SPY gets closer to in the money, the contract starts to move better. And then once SPY goes in the money, so you guys can see right here we cross 512. Look how nice the contracts start to move. And then they just rip. They rip. They rip. This is because when a stock goes from out the money to in the money in your contract, you get a premium pump because the extrinsic value turns to intrinsic value. You're probably super confused right now. So let me simplify this for you. So look, stock's at 511.72, right? 511.72. If stock goes to 512, if stock goes over 512, and you have 512 calls, then these contracts are now in the money. They're in the money, team. Does that make sense? They're in the money. When a contract gets in the money, it gets a premium pump. They start moving better. So again, guys, if the stock is at 510, then out the money equals 511, 512, 513, etc. In the money is going to be 509, 510, 508. So say then the stock goes to 511.50. That means in the money is now 511. That means the 511 calls, if you were to buy them out the money, they went from out the money to in the money. Now they're moving really, really good. So guys, that might sound a little bit confusing to you guys, but if you're overwhelmed, it's okay. I understand. It's okay. Just relax. Take a deep breath in. Keep watching. Let's go over the mindset you need to have to become a profitable trader. Let's go over a little bit on some mistakes you need to avoid. So I want to go over some mistakes you need to avoid when you start your trading, guys, whether you're starting or you're unprofitable. First off, you're going to lose. You're going to lose trades, but it's all about how you recover from your losses. There's a few different ways people mess up when they take a loss. First thing is they chase. That's the worst thing. So you take a loss and you say, I need to make my money back. I need to make my money back now. I need to do this. No. They think they need to make their money back today, when that's not true. What you need to do is start every day with a fresh mindset. Act like your P&L is zero. View the long run. Tell yourself, okay, I lost, but that's okay. I have years and years and years and years of trading. I'm not going to ruin my years and years trying to make back one trading loss. No. Instead, I'm going to keep following my rules. I'm going to size consistently. I'm going to start fresh. And I'm going to hit base hits. The truth is, you guys are going to lose when you start trading. You guys lose at first. I lost for over 2 years when I was started trading. But I didn't view those as losses. I viewed it as market tuition. You guys, nothing that's easy is going to have value to it. Nothing. Value is linked to difficulty, which is why in college you pay to learn a skill, right? Same thing with the market. You lose money to learn how to trade, and it's all about who goes through the market tuition that's going to learn. So I'm trying to save you guys as much tuition as you guys possibly can by giving you guys this bootcamp. Next, don't jump from strategy to strategy. You need to stick to one strategy, which we'll go over in the bootcamp. So I think it's in one of these days, we'll go over my exact strategy to use, the exact strategy you guys to use to know how to buy and sell. but you need to stick to one strategy. I literally trade the same strategy every single day, and I don't care if my strategy doesn't happen, I won't trade. Next, taking a lot of trades. This will kill you guys. Less is more in trading. You need to understand, in the casino, really be smart. In the casino, who loses the most? Usually the person that stays there the longest, the person that gambles the longest. Same thing with trading. You want to trade less. Less equals more in the long run in trading. Preserve your capital. Don't use your hard-earned money if the trade is not an A+ trade. I work too hard for my money, and I'm sure you guys too do as well, to lose money on stupid trades. So I only take A+ trades. Next, most traders mess up because they come into the market and they tell themselves, oh, my goal is going to be to make 5,000 or 10,000 or 15 or 20,000 or whatever it is. You say, I want to make 5,000 a week. That's my goal. Or you want to make 500 a week. That's your goal. Or you want to make $500 a month. That's your goal. Do not set profit goals. Profit goals are going to crush you in the long run. When you have a goal of making a certain dollar amount in trading, you're actually going to make less compared to setting a goal to execute better. So instead of having goals focused on money, have goals focused on performance, goals focused on execution, goals focused on how good or how bad your trading performance is. So for example, your goal could be to follow your plan, or to only take A+ setups, or to only trade setups with a 1 to 3 risk to reward, or to not take trades before a certain time. Set goals that are going to help your trading, not kill them. Next is thinking you can do it alone. Guys, you could really speed run the process by surrounding yourself with like-minded people in a community. Taking this boot camp like this seriously, you could speed run the process. So do not sleep on all the free game that there is out there and the guidance that you can get with trading. Okay, so first thing I want to talk about is basic chart, like setting it up, the basics of charts. So I use TradingView. That's what I look at for my charts. All you do to look at a stock is say I want to look at SPY. You type it in, put it in. So here it says 5 minute. These are all the different types of ways you can look at a chart. The 1 minute, 2 minute, 3 minute, 5 minute, hour, daily. While I'm trading, I like to look at the 5 minute. This basically means that the chart is set up where every 5 minutes there's a new candlestick. So look, 9:30, 9:35, 9:40, 9:45, 9:50, 9:55, 10. Okay? This right here is pre-market. So this is from 4 a.m. to 9:30. That's the pre-market. This right here is extended hours. This is from 4 p.m. to 8 p.m. Okay? So we now know that this is the 5 minute, right? Now you can go to daily. So now this shows what happened every single day. This shows what happened every single day, as you can see. This is all the daily price action. We even go to weekly. This is the weekly price action. This is the chart for every week. While I'm day trading, I like to look at the 5 minute. That's my favorite chart. My favorite frequency, my favorite time frame to look at, the 5 minute. Once I'm on the 5 minute, there's a few different ways that you're able to, first off, read candlesticks. So you need to know a few parts of candlesticks. First things first. So when we hover over a candlestick, so you guys see how at the top of my screen, it says open 596.51 over here. Look right here where this is. It says open 596.51. High 597.64. Low 596.43. Close 597.49, right? The close is the most important part. Close. The close is very, very, very important because the way we view our levels are based off if the candle closes above or below the level. So now that we know what this is, close basically means, okay, when the 5 minute candle closed and started the next candle, where did we close at? What was the price of the candle? Okay, so as we can see, close 597.49, open 597.49. This close is going to be the same as this open. Same exact thing. And then Now that we know about these candlesticks, let's look at these charts a little bit. Let's look, right? Let's just really soak in all the data. Like, for example, wicks. This means sellers are in control when you have top wicks. Well, let's go a little bit into this. So when the chart has a formation where you're consolidating or you're going down and you have wicks like this means that sellers are in control and probably a downside move is incoming. But if you have wicks to the upside, this means that buyers are soaking it up and you're probably going to have a move to the upside. Let's go over some more candlestick patterns, team. So there's the bullish engulfing. This is when you have a red candle, then the green candle overcomes it. This is a potential sign of some uptrend coming. Then you have a morning star. This is another bullish pattern where you have a red candle, big red candle, followed by another red candle, then a green candle overcoming it. Then you have the hammer candle. Hammer candle is an insanely bullish pattern. So as you can see, hammer candle, hammer candle. You usually want to see the hammer candle at the bottom of a trend. So let's see if we can spot any hammer candles today. So as you can see today, pretty bloody day to the downside. Don't see any hammers. And like, these aren't patterns you guys are going to see every day, but these are patterns you just need to know, you know? You need to know them. That's it. Okay. Right here, we have a hammer candle. So you guys can see, going down, wicket right up, hammer candle. We close the top of the candle. You always want to see the hammers close towards the top of the candle. This right here, perfect example of another hammer candle. See, they wicket right up. When you see this candle, usually a sign we're going to go up. So now we have, so this one's basically the same as a hammer. But now we have bearish engulfing. This is a very important candle. It's when you have a green candle followed with a red candle. When I have a bearish engulfing, and for some of you guys who are more experienced, when I see a bearish engulfing on a retest, I don't take the retest. It's not an A+ retest. So let's go to Apple. I want to say bearish engulfing somewhere around here. Oh, it was Google actually. Yep. So let's show you guys an example of a bearish engulfing on like a good looking setup. Look, this is not exactly a bearish engulfing, but it's pretty close. See, this red candle is way bigger than the previous green candle. And then this is where the real engulfing comes. Green candle, then this red candle is way bigger than it. This would have saved you a lot of money. You would have realized this is a bearish engulfing with a 3-bar play to the downside. Look what happened right after, downside, after this bearish engulfing. Next, evening star. So basically something like this. I think NVIDIA had something like this today. Let's check. I remember seeing something like this on NVIDIA today. Again, you guys need to know these patterns. Like, you guys realize what I'm saying? I think NVIDIA had this today, and you know? So look, right here, sort of right here, and sort of right here. See, it would have saved you a lot of money. It would have told you you're going down. You could have bought puts. Right here, we have that up movement, then right back down. This is basically setting up a flag. These evening stars, just like a bear flag. Then you have the shooting star dash gravestone doji. I call it the gravestone doji. This is the most important candle. This is the most important candle right here. Gravestone doji basically tells you that the trend is about to switch. So if you're ever looking to trade a retest, say there's something like this, right? Stock looks really good. We're ripping. We break over the key level. So that's our key level. And then boom, candle like this. And then there's a candle like this. I do not take this normally. This is not an A+ trade because this candle is indicating me there's a lot of sellers. Usually what happens is the next candle is a big red candle. So let's see. Look at this. You would have traded the pre-market high retest, but you didn't realize there was a gravestone doji at the top of the trend. The gravestone doji's candle like this, top of trend, close at the bottom, and you would have taken the pre-market high retest. You would have lost because there's a gravestone doji. So again, guys, this is a pattern that tells you that the stock is most likely about to go down. So do not buy calls when you see a candle like this. And if you see a candle like this in the daily time frame, it's really hard to find because it doesn't happen that often. But if you see a candle, a gravestone doji, at the top of trend, that is a very bad sign. Look, this bearish engulfing at the top of trend, go right down. Bearish engulfing, top of trend, go right down. That's this one. Let's try and find a gravestone. Again, they're very hard to find. on dailies, because if it happens, you always buy puts. I always buy them at least. Here we go. Not the most A+ one, but sort of a gravestone. Next candle, gap down. See if we can find another one. Gravestone. Next candle, gap down. But yeah, you guys basically get it. Oh, right here, this is a nasty one too. Gravestone, boom. So yeah, guys, those are the most important candles. Now I want to go over some general kind of chart patterns. So we have a double top. This is when the stock hits it like this, and then you basically trade the break of this level right here. Double bottom, when the stock bounces off level twice. Support and resistance level, this is my absolute favorite thing ever in the whole world. This is literally my setup. You have a resistance, break above the resistance. That resistance now becomes a support, which we're gonna go over how to find resistance, supports, and all that. You got demand, supply, bearish flags, support, resistance, bullish flag. We'll talk about flags real quick, guys. I want to talk about flags with you guys. So flags are basically consolidation after a move up. So like this is a flag, and then you go up, right? So let's do it in candle formation, something like this. And then maybe, like, let me just show you guys. Something like that. It's consolidation. It's healthy for stocks. I think Netflix had a flag the other day. Yep, it did. Check this out. We have a move up on Netflix, and then we have consolidation. We have a flag. See how it's flagging out? What happens? We break above the flag, this high, and we rip. This is a bullish pattern. Very bullish pattern. Let's find some more. Apple. As you can see, we're having a move up. Then we got this flag. We broke above the flag, and boom, rip. These are sort of smaller flags, but they're still flags. I think PLTR had some too. Yup. Look, guys, it doesn't have to be like an actual like flag formation. It just needs to be consolidation. Like this right here, this is just stock flagging out. As you can see, flag after move up, and we rip. Now let's show you guys something else. I want to show you guys what a flag looks like. So look, check this out. Move up, consolidation, rip. That's a bull flag. Move up, you see this consolidation after the move up? This is a bull flag. This is healthy for the next move up. And I didn't even pre-pick these or anything, guys. I'm walking them through with you guys live because I know it works. I know this stuff works. There's also bear flags, guys. There's also bear flags. So as we could see, move down, consolidation, dump. And now you may ask, okay, PB, how do you know if the trend is up or down? This is where we go into how do you find key levels. So first off, there's 3 different types of key levels, guys. There's 3 different types of key levels. Let's go over them. There's psychological key levels, there's pre-market levels, and there's other key levels. What you need to realize is with every single level, there's a support, there's support, and there's resistance. And the way I trade is we want the support and resistance to flop. So what does that mean? That means, well, everybody's trying to buy support and sell at resistance, right? What I like to do is I like to wait for the resistance to turn into support, or for the support to turn into a resistance. So when a resistance gets broken above, it turns into a support. When a support gets broken below, it turns into a resistance. So remember, guys, support dash resistance flip. As you could see, we have this resistance. We then break above the resistance. We come back down. We test it. This is the resistance. The resistance is a level of where there's sellers, a level it's hard to get above. You see? The level you keep rejecting off of. Support is the level you keep bouncing off of. So what happens when the level you keep rejecting off of gets broken above? That means it's going to be a level you bounce off of. That means it's where you want to enter. And the best thing is when you trade this, you already broke above a resistance. You're trending to the upside. So the way I like to trade is I like to buy calls when the resistance turns into support, and puts when the support gets turned into resistance. And there's 3 ways to find the support and resistance. There's psychological levels, there's pre-market levels, and there's other key levels. First thing I want to go over is pre-market levels, and it's very, very simple. I mean, guys, I have literally 20 videos on this in my YouTube. Literally 20 videos on key levels and all this on my YouTube. 20 Twitter threads, everything. So we'll just do simple. Pre-market levels are simple. So you guys see this like shaded yellowish area here? We're going to mark the high of it, and we're going to mark the low of it. That's the low of it. This is where it turns into a blue. All you want to see is if the stock gets under the pre-market level with the 5-minute close. So the level is 597.49. On this candle, we closed at 597.08. So now we're under it. Once we're under it, we want to retest it. We're going to come above and test it. So as you can see right here, we test it. This is where we're buying puts, because the pre-market low, the support, now turns into resistance. This is where you want to buy puts. And as you could see, huge move down. Huge move down. And this is the pre-market high. So guys, I'm not really going to go into actually showing how to execute, because that's going to be in, I think, day 3 or day 4. Correct me. One of these days, I'm going to do that. But I want to show you guys the key levels, and I want you guys to practice getting the key levels down. Pre-market low, pre-market high. Now let's mark pre-market low and pre-market high in 5 stocks, okay? Let's do it. So, okay. Pre-market high, pre-market low. Let's see. Pre-market high, pre-market low. Okay. Let's go to a different stock. Pre-market high, pre-market low. And obviously the high is a resistance, the low is a support. Pre-market high, pre-market low. Pre-market high, pre-market low. Okay, now you guys get it. That's how you mark. That's your first key level. It's pre-market high and the pre-market low. Next key level, we're going to go over psychological levels. And it's as simple as you think. Psychological levels. If the stock's at 100, 100 is going to be a psychological level. 105, psychological level. 110, psychological level. 115, psychological level. Usually every $5 to $10, psychological level. For example, let's go to Tesla, right? All you're going to do, okay, 450, psychological level. 445, psychological level. 440, psychological level. 435, psychological level. 430, psychological level, okay? That's literally all you do. Let's go to a different stock. Let's go to Google. 190, psychological level. 195, psychological level. 200, psychological level. Every 100 is a huge one. Every 100 and every 50 is a huge one. Always remember that. The 5s is pretty small. Like 190, 195 small, but like 190 big, 200 big, 210 big, 220 big. These are psychological levels. These are levels you need to have on your charts. So the next one would be 205, and then we're going to do 210, but we know 210 is a bigger level than 205. Okay, that's psychological levels. Next is other key levels. This is where I need you guys to really pay attention. These are levels that the stock usually has a big move off of. These are levels that you don't have marked down. Like, for example, let's go to the daily on NVIDIA, okay? Let's go to the daily off NVIDIA. So as you guys can see, I have all these lines, and it's probably overwhelming you guys. It's probably overwhelming you guys. But this is okay. All I did, so there's a rule for these other key levels. You want to have 3 taps or a new high or low. So 3 taps of a level, or 3 times that it's moved largely off of it. 3 pivots. So let's do the math. Let's check. Okay, every time we get to 101.50, we bounce to where? 110. And guys, the way you find these other key levels is all you do is mark the top and the bottom of flags. This flag. So as we can see, we have this consolidation. Let's mark the bottom of it, because we know every time we get to 110, we bounce straight to 115. As we can see, twice we did it here. And then we get above 117, we get to 123. Since look, boom, we get above 117, we hit 123. We get above 117, we're at 123. 118 to 121. 117 to 123. 118 to 123. We break above 123, we go to 132. Now we know, okay, the next time we get to we hit 117 or we break under 123, we're going to go to 117, because those are our key levels. Those are our key levels. You also need to mark the highs, so all-time high. This is the level we stopped going up at, right here. So you have to mark that. So let's keep looking. Okay. I know that every time. So look, we then go to 123, right? You guys see these wicks? You guys see how we have this consolidation at levels? How whenever you guys see something like we're moving, right? We're moving, and then boom, we're just stuck at somewhere for a little bit. That's a big area. You have to mark the high and the low. That's why we're doing that here. So as you guys can see, oh, now we come down to 117. Where do you think we're going to go? We're going to go to 123. What happens? 117 straight to 123. 117 straight to 123. If we break above 123, we know that the last time we broke above 123, we went straight to 128.30. So what happens? We go above that all these times. So now we know if we break under 123, we're going to go to 117. So that's the next level. Guys, the stock market doesn't move randomly. It moves level to level. And now we know that if we get above 130.3, this is that resistance here, right? You guys see we rejected off of it. You guys look, resistance, support dash resistance flip. What do you guys think is going to happen if we get above this level? I'll tell you, we're going to bounce off it. What happens? We get above it, we rip. This is the retest. We retest the level. This is the support dash resistance flip. This is where you buy. And what happens? We go straight back up. Straight back up, team. Straight back up. And those levels still play out. Look, this is that level, right? It's almost like we just bounced off it. It's not random, guys. I know this is the kind of hardest levels you need to learn, but literally just mark the levels. Mark the top and the bottom of areas we eject off of and areas we bounce off of, okay? So let's do it fresh. We could do it fresh. I could do fresh for you guys. So here, you know, this is going to be a big level. You know, this is going to be a big level because look. And then how many times we bounce off this? 1, 2, 3 times. And every time we bounced off of it, we got to at least 92. So now I know if we get above 86, we're going to go to 92. And look how many times this like area played out. And then when we get above 92, look what happens. The resistance turns into support. All this resistance. This is turns to support. This is where you buy. And now we know if we get above 92, we're just going to go to the next level, which is this area. Crazy. So I kind of hope you guys understand. Those are how you find those levels. But again, we have the pre-market levels, the psychological levels, and the other key levels. Okay? And the other key levels. Another thing you could also do is like, okay, we go to NVIDIA, right? Let's go to NVIDIA. Oh, it's not here. Here you go. So you guys see how we have this high day here in the morning, right? A high day here in the morning. Once you get above a high day, so right here, once you get above a high day, this high of day is a resistance. You get above it, it turns into a support. So for example, you could have bought calls. You should have seen this resistance, seen it went above it. Now you're waiting for it to come back down, retest, which it retested right here. This is the flip. That's the flip. So always mark your high days and low days as well. Okay? Always mark your high days and low days as well. So guys, real quick, I just want to go over how to find the trend. Just like simplify. All you do is when you mark your pre-market high and pre-market low, once you get a 5-minute close, like right here, above the pre-market high, that means the stock's going to trend to the upside. Once you get a 5-minute close below the pre-market low, that means the stock's going to trend to the downside. It's that simple. So let's do it like this. Stocks above pre-market high equals trend is up, okay? Stock is below pre-market low equals trend is down. And excuse my handwriting, please. So remember, that's how you find the trend. You just mark your pre-market high, mark your pre-market low. Above the pre-market high, trend is up. Under the pre-market low, trend is down. And guys, that's chart analysis simplified. Everything's very simplified, guys. There's obviously lots more to it, but I'm trying to just give it all to you guys as simple as I possibly could. And the most important concepts. We're gonna go deeper into market analysis, market structure, setting up your trading plan every single morning, how to do your pre-market analysis on stocks to figure out what's gonna go up, what's gonna go down, what are you gonna be watching, and so much more. Today, we're going to talk about finding stocks to trade, pre-market analysis, a pre-market checklist, market structure, and in general, how to prepare for the market. This is where you start planning your trades, and honestly, it's a habit that's going to completely change the way you do your trading, because one thing I really like to say is failing to prepare is preparing to fail. There you go. So let's get straight into it. We'll be talking about why pre-market's important for the market, how to prepare for the market, morning routine, pre-market checklist, and just in general, how to be prepared and scan for the market. So guys, this is going to be a little shorter one since it's just not that much. And after this class is where things start to get very, very spicy, where we go into VWAP, and then we go into entries, exits, and risk management, trading psychology, putting it all together. But this class is going to be very important, so stay tuned. At the end, the pre-market checklist I'm going to give you guys is very, very important. So you're not going to understand it though unless you watch the rest of the video. I'm going to start it off with just going over how I find stocks to trade. Okay guys, so how do I find stocks to trade? First off, as you guys can see, this is literally my watch list right here. Saying I watch the same stocks every day basically, unless something's popping like insane. MU, Target, Square, IWM, SMCI, Netflix, Hood, Nvidia, GameStop, Qs, Apple, Google, Microsoft, Coin, Meta, SPY, Tesla, Amazon, AMD. More or less like these up here and not GameStop. Move GameStop over here. But yeah, so as you guys can see, I look at all these are the stocks I like to trade. And when I was starting off, and what I would recommend for you guys starting off is stick to just a few of them. Maybe stick to AMD, Meta, Google, Apple, or whatever you want to stick to. But for me, I just stick to a few stocks when I started, then I just added more and more and more and more and more. And I eventually kind of found how I like to trade, and I just kept incorporating the big stocks that have a lot of volume on their options. So what I want to go over, guys, is how do I find stocks to trade though based off this list. So say these are the main stocks really. These are the ones I have right here. The other ones I watch as well, but these are the ones I trade the most. As you can see, what I look for is what's up the most and what's down the most. So as we can see, our percent change right here, we have Amazon up the most, up 2.48%. And we have Coin down the most, down 10.78%. So now we know that Amazon is going to be the strongest stock of the day, and Coin is going to be the weakest stock of the day. Okay? The weakest stock of the day. So after I know this, what I do is I go in and look at the chart. So let's look at it for today. Seems like AMD was going to be the strongest stock of the day. Strongest stock of the day, but if the market's all red, and then I look for the red stock. So as you guys can see, on this day, it was about 50-50, so it doesn't matter. You can look at whatever. But I did end up picking Amazon since Coin was already down 10%. So AMD strongest, and it looks like, okay, I wasn't trading SMCI. Tesla was the weakest, down 5%. And as you can see, what I did is you mark your pre-market low, you mark your pre-market high. This was a really hard retest to trade because it was such a small retest, but we did get the retest. But yeah, so once I find those weakest stocks of the day, sometimes I don't just focus just on one either. Like we see Tesla very weak. We see Coin very, very weak. So for Coin, what would I do? I would mark the pre-market low, pre-market high. Nvidia was also pretty weak. So what do? We mark the pre-market low, we mark the pre-market high. So once I find my strong stocks and my weak stocks, I mark my pre-market highs and my pre-market lows. So let's make our little checklist. Let's make our checklist, okay? Let's make it on here. So first things first, find strongest stocks, weakest stocks of the day. This is pre-market. Next, mark your pre-market levels. Now third, what do we want to do now? Now, once we have our strongest and weakest stocks of the day marked out, we have our pre-market levels done. Now what we need to see is we want to watch them. But let's do a little bit of a test. So guys, think in your head right now. If I was just watching these 5 stocks, we have SPY up 0.5%, Apple up 1%, Nvidia down 0.2%, AMD plus 0.7%, and Meta up 2.3%. Which is the strongest stock of the day? Think about it. What's going to be the number one stock we're watching for calls? Think in your head. All right, Meta, since it's up the most, as simple as that. And if the market reversed and magically went red, then NVIDIA would be the one to watch. But remember, market's red, you focus on stocks that are down the most. Market goes from red to green, you focus on stocks that are strong. So this is an example on a trade you kind of want to look for. So QQQ opened up green. So it was green. So I was looking for the strong stock of the day. And then since QQQ was green, I saw that Amazon was strong stock of the day, right? Amazon. So then what did I do? I want to show you guys something that you guys need to look at. Look at this QQQ price action. So look at how weak we are right here. Look at how we dumped right here. While we dumped, Amazon was trying to rip. We were going up, as you can see here. This is a very good sign. This means we have a confluence. This means it's moving stronger than it. That's what you want to see. You always want to trade stocks. If you're trading calls, you want it to be stronger than the index. So, for example, when the index goes up, you want it to go up a lot. When the index goes down, you don't want it to go down that much. So, say this is a move like this happens in the index, you want to see something like this in the stock. This is what you want to see in the stock. So, as we can see, if Amazon is going up and holding while QQQ is dipping, what do you think is going to happen when QQQ starts to go up? Amazon is going to rip, and that's exactly what happened. Same exact thing happened today. Let's go over it. So, I mean, we could look at Tesla. We can go look at literally like anything, but let's look at Tesla. So, I mean, sorry, not Tesla. So this is QQQ. Oh, what do I want to look at? Check this out. Check this out on QQQ. Well, let me check this out on Microsoft. So 945. I want to look at a few different names. Let's look at Microsoft. So QQQ had a green candle, right? We had Microsoft had a green candle also. Okay. Google had a green candle also. Okay. Apple had a green candle also. Okay. NVIDIA had a green candle also. Okay. Amazon had a green candle also. Okay, cool. So what's so different about these green candles though? So Amazon's green candle didn't engulf the previous candle. When you have Microsoft's engulfed it, NVIDIA's also almost overtake it, and it had two of them. So here we could kind of see that Amazon's the weakest one. So what you want to look for, and even though that wasn't such a clear example, which I'm sorry about that, but you guys just want to really look at like, okay, what's popping the least as QQQ is popping right now? You know, like what's super, super weak and barely popping with the market as this pop is happening? And then look, QQQ went down half of that candle. Amazon went almost slow a day the next candle. Then boom, dump. Even though the whole market did today, it's just like it's kind of showing you guys how you need to look for the weak compared to the indexes. You need to look at what's moving the weakest compared to the indexes. And it's usually going to be the names that are down the most. Okay? Usually going to be the names that are down the most. So today, that didn't really happen because everything was just down a ton. But again, it's usually going to be those names that are down the most. And as you can see, like Tesla bounced right off, and as Q's barely bounced, Tesla bounced really hard, which is weird because it's down the most on the day. So not all the time does this happen where the confluence is going to hold. But on the initial retest, it's usually pretty well. So let's try to find... So yeah, guys, step number 3 is going to be look at the confluence. Find the stock that is the weakest when the others, when that is the weakest or strongest when the others are pulling back or retracing. Because I want to be in the one that's retracing the most, you know? I want to be in the one that when QQQ bounces, it doesn't even bounce. It's that weak. That's what you want to look for, honestly. So like, for example, look at this. Even though Google had a big candle here, QQQ had a green candle. Google didn't have a green candle, you know? And then Google went right back down to low day, then the whole market reversed. So again, today, like everything was a trend day, so it doesn't really, it's hard to show. How about yesterday? Let's see, how about yesterday? All right, let's go into the video. No, there's a really big level here, I'm pretty sure. But do you guys see how right now I'm watching the confluences? Do you guys see how I'm watching how NVIDIA is moving compared to Q's? How NVIDIA is moving compared to AMD? Like, let's look at AMD, December 23rd, right? Look at AMD, December 23rd. While NVIDIA started to rip towards high day, AMD was pulling back. See, as you can see right here, the lines are moving together. So right here, NVIDIA has moved to high day and ripped almost $2 while AMD was staying stagnant. You want to be in NVIDIA here. You want to make sure you're in NVIDIA calls, not AMD calls. And that is super important. That's finding the strongest stock of the day. And the way you do that is by scanning as well. So every Sunday, spend at least an hour reviewing stocks like SPY, Qs, NVIDIA, Amazon, Tesla, all those stocks. I look for the patterns from the last class. I look for flags, levels, and gaps. So remember all in the last class, those patterns I went over, those are what I'm looking for. And then I'm journaling my trades every single week. I'm gonna go more into this on I think class 5 or class 6. But again, I'm consisting of cutting out what's not working, seeing what is working, seeing what trades messed me up last week, what stocks did I read wrong, and why did I read them wrong, so that I'm not reading them wrong for this week. And then every single morning, obviously, we're doing the strength and weakness scans, looking at them compared to indexes. We're trying to catch the potential if a stock's gonna go from green to red, if the indexes go from green to red, which stock's gonna move the most, if the indexes trend, which stock's gonna move the most. That's what we're looking for. And that's literally all based off what's up the most, what's down the most, and the confluence. So watching one stock compared to another stock. So like today, I actually took a loss today. And let me show you guys why. So we go to Bitcoin, right? And this is how knowing the confluence saved me. I went from, if I didn't know how to read confluences, I would have lost a lot more in this trade. So look, I took puts on coin right here. I took puts on coin right here, right? So what time is this? 15:25. So let's see. Right here, I took puts on coin. Right here. So this is the candle I took puts on. And this is the candle on coin. You guys see how then Bitcoin hit a new low a day and coin didn't? So I took a trim here because I was like, oh man, coin should be moving way, way, way weaker. And it's not. That means that it's trying to have strength. And then I moved my stop loss up. So my stop loss was up here. I moved it to right here. And then what happened? Bitcoin started to consolidate. And this consolidation made coin rip. And I got out right here for a very, very, very small loss after taking a trim because I was able to read that consolidation. I read that if Bitcoin is dumping and coin is starting to not severely dump, then if Bitcoin goes up a little bit, coin is going to rip. And that's exactly what happened. Exactly. So that's why you need to be able to read these confluences, guys. And with everything else, it's usually Qs or SPY. And then on the crypto names, I look at Bitcoins. So on coin, I look at Bitcoin. And obviously tech names QQQ. But yeah, guys, so that's how you scan. That's how you find the pre-market checklist. Also want to add to this a little bit. After we look at the confluence, every single pre-market, we also want to make sure we know the potential, the key levels need to be marked out for the stocks you want to trade, for the strength and weakness ones. And you need to know the potential economic data for this day. You don't want to enter a trade at 9:59, then 10 a.m. data is going to come. You also want to make sure the stock you want to trade doesn't have earnings this week. So you never trade a stock pre-earnings same week because the contracts are messed up. Okay? The contracts are messed up. So guys, this is our pre-market checklist. Number 1, you want to find the strongest and weakest stocks of the day. Number 2, you want to market pre-market levels. Number 3, look at the confluence. Number 4, the key levels need to be marked out for the strength as weakness stocks. You want to be prepared. Number 5, review the economic data. And number 6, just make sure the stock doesn't have earnings this week because you don't want to enter a trade and then get screwed because of that. And this is what you really need to be prepared, as well as you need to know if the stock you're trading has candlestick pattern on the daily. So as you guys know, we're looking at the 5-minute now. So let's zoom in real quick. Looking at the 5-minute now, you want to make sure in the daily, you want to check if it has any patterns because that's going to help your trade out. You know, it gives you more confluence because a larger time frame setup is better than a smaller time frame setup. That was a little bit of a shorter one. And I'm not going to say not as important, but it's something you need. You just need to have these things marked down. This is like the boring stuff in trading that like you don't really think about, but you need. So I hope you guys kind of have that written checklist. I want you guys to practice it for the rest of this boot camp every single morning. I want you guys to do those, get those things done every morning and be ready with them. Make sure you're ready for day 4 because we're going to go into the best trading indicator, the simple trading tool that I use. This tool alone has made me 6 figures. I mean, VWAP is the literal best indicator for the best trades. I hope you guys are enjoying the video, but really quick, I wanted to let you guys know that I'm hosting a free 3-day trading masterclass. So I'll be going over everything you need to be a profitable trader from A to Z for 100% free, March 23rd, 24th, 25th. If you're interested, click the link below and register. It's 100% free and there are limited spots. This will be a live event, so I'll see you there. Click the link below and register. Okay, so as you guys can see, first off, I want to go over what is VWAP. The VWAP is the volume weighted average price, and it shows the average price of the stock adjusted by the volume. VWAP allows you to trade with low risk, high reward, and it's usually a huge intraday pivot. But I use VWAP a lot differently than other people use VWAP. Let me simplify it for you guys. VWAP, think about it as this. You know how when you enter a position, you have your average price? VWAP is everybody's average price combined into one. So it's basically the average trading prop of the stock, the average trading price of the stock for that day. So say VWAP is at 100 and the stock's at 101. That means the average trading price for the stock is 100. That helps you a lot because now you know, okay, if the average person's in the stock at 100, then at 101, they're probably going to keep holding. But if it goes back to their entry, people typically buy more. So maybe I could trade a bounce off of it or a retest off of it. We're trading of other people's psychology. And like another thing is like, for example, usually when somebody goes from down a lot to then even, they'll get out because they're like, oh, I'm not going to risk it, right? When we get that, we view it as a retest. We could see their entry due to VWAP. We view that as, this is a bearish retest. Let me enter puts. So there's 2 ways like to trade VWAP, and these do have to go with pre-market levels as well, which we're going to talk a lot about tomorrow, the exact entries and exits in a lot of these stocks. So let me just give you a basic overview of VWAP. There's 2 ways I like to trade VWAP, a bullish VWAP bounce or a VWAP reject. A bullish VWAP bounce is when a stock is over VWAP and over pre-market high and the trend is bullish, meaning we're going to the upside since we're above pre-market high. We want to wait for it to dip and we want to see volume at VWAP. Once we see the buyers start to buy it off of VWAP, once we start to see a little bit of green off VWAP is when we want to enter our calls. So as we can see, this is our pre-market high. We're above pre-market high and VWAP is above pre-market high. So right here, we come, this is purple line is VWAP. I personally like to make my VWAP yellow, but this purple line is VWAP. As you guys can see right here, we come down and bounce right directly off VWAP. My entry is right here off of VWAP. As long as we're holding VWAP, I like it. Here, I wouldn't have taken it because I didn't tap it. But here, for example, I'm taking calls because we're right off of VWAP. And we do that every single time. So let's go over some more. Here we go on Qs. We have our pre-market high, right? Pre-market high. Next, we're above VWAP, ripping. VWAP retest, calls. Another retest of VWAP, calls. You want to eat up these dips to VWAP. These dips to VWAPs are very good entries. So again, all you do, guys, is when the stock is above pre-market high and it goes and it comes down and tests VWAP, this is your entry for calls. This is where I like to buy calls. It's a bullish VWAP bounce. Another great example, we have our pre-market high. We're above pre-market high, and we don't get any retraces until finally we get a bounce off VWAP. And isn't it coincidence? That's literally the exact bottom. We bounced directly off of VWAP. Guys, we're not guessing. There's a math behind this. There's a reason that I'm picking VWAP. It's because it works. It works. Look at these bounces. Look at these retests off of the line. So now let's go over it to the downside. So a VWAP reject is when the trend is bearish and the technicals are indicating to short pops. That means we're a 5-minute close under pre-market low. The stock is weak and we're looking for a retest to buy puts. We want to wait for the stock to bounce a VWAP. And if we see some wicks start to come in, so remember guys, class 2 wicks, we see wicks start to come in, we're going to buy some puts. So right here, VWAP retest under pre-market low, boom, we buy puts. Again, we're under pre-market low right here, We get a retest of VWAP twice. And isn't that crazy? The best possible entry of the whole day right off of VWAP. And then we dump for the rest of the day. Again, right here, we have our VWAP, our yellow line, right? Our yellow line. We're under pre-market low. As we can see, we're under pre-market low. What happens? We dump, we dump, we dump, we dump. We start to bounce. Most people just guess. They think, oh, I'm just going to buy it here. I think it's going to start going down here. Or they think, oh, it's definitely going to start to dump here. We don't guess. No, that's the one thing you shouldn't do, is front run it or guess or do something stupid like that. Wait for it to hit your entry. We don't guess. What happens? We get a VWAP retest. So what are we going to do? We're going to buy puts right here off of VWAP, which is what I did. Then we go right back down. What happens? We get another VWAP retest. So what are we going to do? We're going to buy puts again. And then we get another VWAP retest. It just keeps on giving. Then we get another VWAP retest. And then, you guys see how all these retests have something similar? They all have wicks. The one that doesn't have a wick is the one that it bounces off of. So you always want to look for that wick. That wick is very important. And you want to look for it just to start forming. So you want to start seeing it go like this before you enter. That's going to help you a lot. Those wicks. So, and you may ask, so PB, when do I get out when I'm trading VWAP? You want to get out when the stock, if the stock closes above VWAP. So you guys see out here, wick off VWAP, wick off VWAP, wick off VWAP. So if you were to enter the puts right here, you would have gotten out on this candle since we went above the VWAP. So you just get out on the 5-minute candle above VWAP. Let me show you guys some more. So it's always the 5-minute time frame, guys. So for example, right here, another VWAP retest. We wouldn't have taken this right here, but once you got that wick, we could have taken it, and boom. So let's look. Bullish VWAP bounce off Tesla right here. Amazon, I mean, guys, this doesn't get more A+ than this, right or wrong. I'm just pulling up charts and look at this. VWAP bounce number 1. We're above pre-market high. We go right to VWAP. Oh shoot, that was the wrong thing. But anyways, we're above pre-market high, right to VWAP, bounce. Look at this, guys. Most people are gonna guess when to buy. They're gonna guess when to buy. They're gonna guess when to buy. They don't know when to buy. They're gonna keep guessing. Instead, we wait for it to come to VWAP. We buy calls off VWAP, and we look at that. Look at that. It's insane. It's insane. We're not guessing. We're trading a system, the VWAP system. This indicator works. We bounce directly off of VWAP, this yellow line. And I want to show you guys also my VWAP settings because I get so many questions about this. So as you guys can see, this is what I use in my VWAP. So I don't know how you want to copy it or whatever, but this is my VWAP. And I make it the yellow line. I only use the middle band. So let's look at an example. Let's try and find an example where VWAP would have lost. I guess right here. So you would have probably taken calls around here and you would have gotten stopped out right here. That's it. Small loss. You would have lost 50 cents. And if it would have won, you would have won a couple dollars. Easy. But look at this. The day before, you would have won 3 times off VWAP. 1, 2, 3. Isn't that crazy? Hope you guys understand how VWAP works. It's simple. And there is one rule I need to go over, guys. There's one rule I need to go over. And this needs to be nailed into your head. Never buy puts when a stock is over VWAP. Never buy calls when a stock is under VWAP. And VWAP bullish retests work when the stock is over pre-market high. VWAP bearish retests work when the stock is under pre-market low. Remember this, guys. Remember these rules. You never buy puts when a stock is over VWAP. Never buy calls when a stock is under VWAP. VWAP bullish retests work when the stock is over pre-market high, and VWAP bearish retests work when the stock is under pre-market low. So there's a little bit on VWAP. I'm going to give it to Ali, let him go a little bit on VWAP and the EMA, and then back to me.
Okay, so PB explained VWAP, but now I'm going to go into the 9 EMA. So I'll give you a little background. I am an EMA trader. That is what I like to trade, and this is my specialty. So what is the 9 EMA? So the EMA is an exponential moving average. Okay, so you'll see a lot of times you'll see things like the 50 MA, which stands for just moving average. And why do we use EMAs over MA? It's very simple. It focuses more on the current candles forming. And if we're day trading, do we care about the current candles or do we care about the candles in the past? The answer is we care more about the current candles. It's more accurate, okay? And we only care about the current price, and therefore we don't use moving averages. At least for day trading, right? If you want to talk about, dailies, all that, that's way too complicated. Let's just focus on the EMAs. So something that me and PB both love is to make rules. How often in your trading journey have you thought to yourself, well, I need trading rules. I don't really have any rules. I just kind of go with the flow. Well, we already talked about the VWAP rule, so now we're going to add one more layer to it, and that is going to be the 9 EMA. So if you want to trade like PB or myself, the 9 EMA is this red line right here, and I will show my settings in a little bit. So rule number 1, this is the bull rule, okay? This is when the stock goes up and to the right. You can see that we are above VWAP, okay? So check mark, and above the 9 EMA, and the stock is trending up and to the right. Very simply, we're going to buy calls here. We're not going to buy puts. Why? Because if you keep trying to buy puts, you're just going to keep losing money every single candle, and you're going to have a bad time. Think of trend as probability. If the entire market is going up and to the right, you off your phone or on your laptop is not going to beat Wall Street at their own game. They always win. Next, let's talk about rule numero 2. Okay, bearish EMA. So you can see we're below VWAP and we're below the 9 EMA. That means price is going down and to the right. We're going to buy puts here. If the market is selling off, you do not want to be buying calls here over and over and over again. Remember, don't step in front of a moving train. Trains, fun fact, actually take about a mile to stop. Okay, price, when it's crashing, takes days to stop. You'd rather be late than wrong. And then lastly, rule number 3 is chop equals no trend, where I call this the Gucci snake rule. Okay, so how many of you have seen the Gucci snake, right? Whether it's on a wallet, on a belt, something like that, it kind of looks like this, right? And that means that the EMAs and VWAP are just kind of crisscrossing all over the place, and that's no fun to trade because you're going to go long, get stopped out. You're going to go short, get stopped out. And I've seen traders over the years lose tons and tons of money trading chop. We do not trade chop, okay? So you're going to buy calls here, you're going to buy puts here, and then chop, we can just cross out trend and we can just write no trades. You're going to sit on your hand and wait for a better day. Now I'm going to explain to you why we only trade on these big trend days, because you can make the most amount of money, especially if you have a small account. In chop, you will not do that. So here is my settings. I'm going to go through all of them individually. Feel free to screenshot. So this is the 9 EMA settings. You can see you set the length to 9 here, okay? And we just want to check this box for wait for time frame closes. For the style, we make it red. Just have these little boxes, check if you want. And then visibility, you want to be able to see it on all time frames. That's all that it means. I know PB went over the VWAP settings, but I wanted to actually show you a screenshot of all the tabs so no one has any questions. So you can see here's the input. No real changes there. But a lot of times when traders come to me and PB, they have these bands here, okay? Get rid of these bands. You just want this box checked right here. And then for visibility, you want it available on all time frames. So feel free to screenshot this if you want and add it to your charts. Okay, so let's go over some chart examples. So price opens in the morning and we're analyzing this. We took the free course and we realized, oh, okay, well, there's 3 rules. So a stock is either above all of the EMAs, below all of the EMAs, or it's forming what we call the Gucci snake. So I'm just going to write Gucci. So let's look at this. So we can see prices, let's say we were looking at an entry around this area. We can see it's above all the EMAs. So we are going to buy calls. That's it. So you would enter calls here or over here, and you would just ride the trend. Your stop loss would be is when it actually breaks down under the 9 EMA, and there you go. That's it. So say you entered off of VWAP here, right? You get your beautiful wicks as PB just explained. You ride it up. Okay, you got a little bit of a knife candle. That's okay. May have stopped you out. Then you enter again, and you just ride it up, and your runners get stopped out at the 9 EMA. Okay, you can see that. Sure, we're under, okay, the 9 EMA here, but we're still above VWAP. So if you tried to short this into VWAP, you would have got screwed. Same thing over here, and so forth. Very straightforward. Now let's look at a bearish example. So we can see, so say we're looking at price here, say, it's forming like a bear flag. Okay, we know the 3 rules. What rule is this? Okay, it's below the EMAs, it's below VWAP, so therefore we're going to buy puts. And you can see you entered puts right off this 9 EMA test right here. You made tons of money on the downside. Okay, a move like this on SPY 0 days is probably 200-300%. That's probably $200-300 in your pocket with one contract just following this, and you would stop out over the 9 EMA. Very simple so far. Now let's look at some more examples. It gets pretty repetitive after you've done this a lot of times. Okay, we have those 3 rules. We're either above, or we're below, or we're somewhere in between. Okay, the Gucci snake. Okay, you can see here we're above VWAP, we're above the 9 EMA, and we trended all day. So all we did on this day is we just bought calls and made money. Literally, all you had to do is buy calls on every single dip, and you made money. If you tried to come in here and short it on this candle, you immediately got stopped out because you didn't follow the rules. Just follow the trend. On a bearish day, we actually started bullish here. So let me zoom in here so you can see. We actually started bullish, but if you remember from the candlestick class, we did what? A bearish engulfing. Okay, so this is not a valid EMA test. And you can see we flipped back down bearish, formed a little bear flag, and then from here to here, probably made like 30%. And then again, every pop to the 9 EMA. Okay, so here's pop number 1, number 2, 3, 4, 5, and just price kept going lower and lower. So you just short every single pop. Oh, there's another pop right here. I mean, it's pretty much infinite money glitch, as we like to call it in the trading game. But look, all day you're just shorting pops to the 9 EMA and you're making money. But you notice how you don't buy calls here. Okay, you're still below VWAP. VWAP, okay, the reason why we actually make it gold, okay, is because VWAP is king. So draw like a little RuneScape party hat. If you know, you know. If you don't know, it's all good. But VWAP is king. Remember, this is everyone's average for the day. We just use a 9 EMA to get more precise entries if we do not get up to VWAP. Price is below VWAP, the market's heavy for the day, and it fades all day. Now, I wanted to show you an example of what chop looks like. So you can see, think back to our example up here. So if I actually look up here, we can see the Gucci snake pattern. And we go down here, we can agree that this looks like kind of a Gucci snake, right? We don't really want to be involved in this. And lastly, okay, is I want to remember one thing when it comes to trading is range. Okay, what does range mean? Breaks a pre-market high or a pre-market low will lead to trend. And trend is your friend. Trend will get you profitable. So that's all I have. A quick lesson on the EMAs. Feel free to take a screenshot of these settings, everything you need, and please, please, please follow these rules. Me and PB have taught many traders when they come in, they follow these rules and their lives are changed.
Perfect, guys. Well, as you guys heard with Ellie, that is everything with the EMAs, VWAP, our system with the indicators, and giving you guys a little bit of what you need to know. But tomorrow, we'll be focusing on what is probably the most important class of all the days, which is entries, exits, and risk management. We'll be going over the system that took me from blowing accounts to finally growing, from taking my account from 1,000 to 25,000 in 3 months, adding up base hits. Literally, we'll be teaching you guys everything you need to know from when to buy, when to sell. How do you know how to manage your risk? How do you make trading not gambling? First thing, guys, is with my strategy, the entry is the most important part of your trade because a bad entry just means that you have a more risk. So bad entry equals more risk. More risk equals lower risk to reward. Lower risk to reward equals bad edge. Bad edge equals lose money. Okay? So that's why an entry, a good entry is very important, because if you got a bad entry, you enter too high, then your stop loss gets bigger, your risk gets bigger, you have a bad edge, and that is how you lose lots of money and blow your account. So guys, your entry is basically going to allow you to have less risk and more reward, which is really, really important. Entry is all about having patience and waiting for the retest. The retest is the magic word today, retest. Retest is our entries. I only enter on retest. And guys, again, ignore my voice, ignore how I'm sounding. I'm giving you guys the sauce, but I'm just really, really sick. So how do you know when to enter? First things first, you need to mark your pre-market highs and your pre-market low in the stock you're watching. So as you can see here, we have our pre-market high marked and we have our pre-market low marked right here and right here. Okay. Next, you want to wait for a 5-minute close over pre-market high or under pre-market low. Once you get that, you want to enter in the retest. So as you can see right here, we have the 5-minute close over pre-market high. And right here, we had another 5-minute close over pre-market high. Right here, we had a 5-minute close over pre-market high. Right here, 5-minute close over pre-market high. Entries everything again, which is why the retest is super, super important. So after you get that 5-minute close over pre-market high, you want it to come back down and tap the pre-market high as close as you possibly can to it, since that's what's going to lower your risk. A retest is simple. It's basically a support and resistance flip. So when the previous resistance becomes support, you want to enter that support. So before I show you guys in the actual chart, let me just give you guys a quick example. Say this is my pre-market high. Say we get a 5-minute close over pre-market high, right? So we get a 5-minute close over pre-market high. The retest is this right here. And you want to enter exactly when it taps it. So the retest is just the stock coming back down and tapping this level, because this pre-market high was a previous resistance that's now going to become a previous support, if that makes sense. That's the support and resistance flip. So as we can see right here, this is the retest. Let me make this white. This is the retest right here. Right here, this is the retest. Right here, this is the retest. Right here, this is the retest. The retest is where you enter. And again, you want to enter as close to the pre-market high as you possibly can. On the retest candle, you do not need to wait for a 5-minute close. You just need to wait for a 5-minute close on the previous candle before it, so that this is your confirmation. We get the 5-minute close over pre-market high. But for when you're actually entering, you want to get it as close to the pre-market high as you possibly can. So right here. Your risk is simple. If you get a 5-minute close under the retest spot, then you get out. This places your risk to reward in such a good spot, because think about it. If we're buying it extremely close to the pre-market high and we're getting out if it gets a 5-minute close under it, we're risking a couple cents to make a lot more than that. This allows you to have small losses and big wins. A little more in the retest though. So as we can see, this is the previous resistance. We get the close over it right here, and we get the retest right here. This picture is a great picture. Same thing right here. Key level, we get the break, we get the small little consolidation, and we get the retest and the move up. So let's go over a position that would have lost. So we get a 5-minute close over pre-market high right here. 5-minute close over pre-market high. Then, unfortunately, you have this big 5-minute candle close under. You would have gone out here. Our target on this was 229.50. Our risk is under the 5-minute candle. And usually the candles aren't this big. So this was a pretty big one. Right here, you risked about, let's think about it. You risked from 228 down to 227.30. You risked 0.70 cents to make, let's see, 228 to 229.50 to make about $1.50. That's a 1 to 2 risk reward. That's like the lowest that goes, 1 to 2, which is still great. With the 1 to 2 risk reward, you can win 33% of your trades and still be profitable. So I'm going to give a little brief on exits, but Ellie's going to go really more into detail. So just simple for exits. If I enter, here's the pre-market high, 5-minute close over, retest. If I'm entering in the pre-market high retest, I'm trying to get some exits at new high days. So as you can see, previous high day, then here we break high day. I'm going to exit a new high day. He's going to go over how you hold your runners. Okay. So here, for another example, I enter on the retest. I trim some at low a day. I got stopped in the rest in the 5-minute close over pre-market low. Since we got a 5-minute close, I had to get out the rest, but I still got a trim. That trim helped me a lot. So guys, let me go over something. So as you guys know, I went over the risk reward and how we're buying it very close to our stop loss. So like if this candle right here goes up, great, we have a big win, right? Big win. We'll take some trims at new high day. We'll scale the runners out. Ellie's going to go over that. But if this candle went like this and close under it, then what do? We cut it fast. cut it fast. Or risking a little to win a lot. I only take a trade if it's at least a 1 to 2 risk to reward. Usually I get anywhere from around 1 to 3. And I have a pretty high win rate, but that's because I go for quality over quantity, which is very, very, very important. So let me ask you guys something in your head right now. If you were to flip a penny 10 times, if you're flipping a coin 10 times, and every time it lands heads, you win $200, and every time it lands tails, you lose $100, anybody would take that bet, right? You have 50-50 chance, and it's 50-50, but every time it lands heads, you win 200 compared to only losing 100. I'll take that bet every time, right? That's exactly what we're doing with trading. Say you have a 50% win rate, which is kind of low. With a 50% win rate, and a 1 to 2 risk to reward, let's see. So you would make $500. You'd make $500. So you would lose 500, but then you'd win 1,000. So what does that come out to? Plus $500. You could easily do this, putting 1K into each trade, max stop 10%, win 20%. This is super low too. When you scale runner, which I'm always going to teach you in a bit, and like literally when I'm done talking, you can get 40, 50, even 100% wins, which in that one trade you'll make $1,000. But boom, with $1,000, you just made $500. And now, instead of putting 1,000, you could put maybe 1,500, right? Which obviously you never put your whole account size, or we're assuming $1,000 your position size. Now it goes from $300 wins, and you just keep growing and growing and growing. Before you know it, with the 1 to 2 risk to reward, this 200 is gonna turn into 2,000. 2,000. The losses will get bigger too, but as long as you have that proper risk to reward, not only can this turn to 2,000, but it can even turn to every time you win, you make 3,000. Every time you lose 1,000. This is how, when you're raising your risk to reward to scaling with runners. So that's why risk to reward is so important. And it might not always be exactly 2,000. Maybe it's 2,500 sometimes. But 1 to 2 is the lowest you want to ever go. So for those of you who are confused, again, 1 to 2 risk to reward is simple. It means you're risking, say you're risking $10 to win, to make $20. Oh shoot, to win $20. Okay, that's just with literally $10, $20. It can go to $1,000. It can even go to $10,000 to make $20,000. All based on how you scale and how you size. But that's a brief overview on how I know when to enter off the retest, off the pre-market high retest, pre-market low retest. When do I stop out? And why risk to reward is so important. Because I'm sure that every single one of you guys would take this bet, right? Because at that point, it's not gambling. It's just a no-brainer, which is how you need to treat trading. Treat it as a business. Create your own odds. That's what I do. Ali, it's all you.
Alrighty, let's get into it. So we briefly talked about entries and exits, but I want to add a little bit more to it. And I think this will be great, especially if you have a small account. So let me share my screen. Okay, so I always ask this question to traders. So if you are entering a trade, what's your risk? I always start with that, because you want to have a risk mindset first, meaning every trade you take, you want to assume you're going to lose money. Don't think about how much money you're going to make. What's the exit plan, right? You always want to map that out in your trading plan. And as previously mentioned, every time you enter a trade, you think, what is my risk? Okay, this is a risk-based business. If you do not know what your risk is, you do not enter a trade. In simpler terms is, where am I going to stop out? What's my stop loss? If you ask me, hey, what do we think about this trade? Should I enter here? I'm going to ask you first, what's your stop loss? Never ever start by entering a trade of thinking of how much money you will make. Okay, this is a money-based mindset versus a risk-based mindset. This is wrong. 90% of traders think, how much money am I going to make? I want to make, 100K a month, right? I want to do all that, but how much do you need to risk to get there? Okay, it's just like business. In business, you put capital into your business in order to grow it to make more money. Okay, it's just like that in trading. Trading is a business. So I want to briefly cover two types of exits. Okay, so the first one is EMAs, and the second one is levels. So let's look at some bullish examples of levels versus EMA exits. So we talked about the retest. So you would, enter the trade on the retest here. This is your pre-market high. So your entry would be right here. And what happens? The next candle opens up and breaks below the pre-market high. So you would exit right there. It's really that simple. And a lot of traders will ask me, is it a 5-minute close? Is it a 1-minute close? If the candle looks like this and it's breaking below on a 5-minute chart, you want to be cutting it. It's really that simple. Sometimes you're going to have to grit your teeth because it'll look like this for 1 minute and then flip back green. So just wait for that 5-minute close. Next is an EMA retest. So this red line here is going to be the 9 EMA. So the price is going up and up and up and up. Okay, and you enter off the 9 EMA test and the next candle opens below it. Okay, you're going to cut it. It's very straightforward. A lot of traders overcomplicate this and read too deeply into it. And I want you to remember from this bootcamp is keep trading as simple as possible, follow the rules, and don't get distracted by the noise. So this is a bullish example. Let's talk about a bearish example when it comes to exit plans. Okay, so again, EMA, price is coming down. You come up, it taps the EMA here. Here's your entry, and the next candle breaks above. So you're going to cut the trade. Okay, you were wrong on your trade, you're going to cut it. 5-minute close over, you cut. Okay, same example when it comes to a pre-market low retest or a previous day low, whatever level you want to use. I just want to keep things consistent. Price comes down, comes up, taps the level you enter here, and the next candle breaks above, you're going to cut it. Why do we cut it there? Because on candles like these, like say, this candle is a little bit aggressive for visual sakes, but say that the candle like stopped here. You only lose like 10, 20%. Same with over here. You lose 10 to 20%. Over here, 10, 20%. Okay, over here, 10, 20%. Notice how this is relatively small compared to our reward. This is key as we move forward. So people always ask me, where do I sell? Where do I sell? They ask PB where he's selling. They ask me where I'm selling. They ask people on Twitter where they're selling. People don't know where to sell. And I'm going to fix that very simply. The golden rule, I even wrote it in gold, is you always sell high a day or low a day if it's a bearish setup and leave a runner. This is key right here. Okay, is leaving the runner. Okay, so make sure you're paying attention as we move forward. So let's look at some examples. So we have, this is going to be a level, LVL for level, and this is going to be an EMA, just to keep things consistent throughout. So you enter right here off the pre-market high retest, you take some more contracts there, you are going to sell some, not all, at high day. Why? Why would you do that? The reason you sell high day is because say it rejects high day, right? Say it prints an ugly candle that looks like this, you already locked some gains in. And then you just stop out the rest of your contracts at break even, or BE as we put it in trading terms. We'd call it break even. That's all you would do. Why? Because it's protects it. If your entry is down here and you stop out on your rest up here, congratulations, the entire trade is green and you don't have any drawdown. So you always want to have your finger on the trigger ready to sell at high a day. Now, for EMA, same sort of method. We're going to sell high day. Okay, so it's high day right here, just the high of the day. Okay, because if it rejects and comes back down, I know it's kind of an awkward looking candle, our entries are down here. Okay, so if we stop out up here, no matter what, this trade is green. No matter what. Okay, same with this trade. No matter what, our entries are down here. We stop loss a little bit above it. The trade is green. Okay, but now, what if the trade keeps going? Okay, so say for here, you're going to say, yo, Ellie, you told me that I should sell low a day. What about the other contracts? What about them? Well, here's the thing. You leave a runner until the EMA breaks. That is why we have an EMA on our screen, okay? Because the EMA just keeps hugging it, goes all the way down. Your first trims up here are going to be, say we sell low a day, right? So you're going to get your 20%, okay? I'm going to make this a little bigger so it's easier to see, right? But what about if you were to sell down here, your runner? What percent would these runners be? These runners would be like 200%. Now, I wasn't very good at math in high school and middle school, but I do know that 200%, okay, is a lot bigger than 20%. And all you do is hold a runner until the EMA breaks. Okay, but first, before we discuss that, I want to talk about the math behind runners and also sizing. Sizing is super important, especially if you have a small account. So let's talk about sizing. So I have 3 examples here. I have a 1K, a 5K, and a $100,000 account. Oh, there's a typo in here. So it looks nice and pretty. There you go. And a $100,000 account. Now, I would assume that you probably don't have a $100,000 account, but I want to show you something really cool. So a $1,000 account, your position size is going to be about $300. Notice how your position size isn't $1,000. Okay? You don't full port here. Okay? We don't full port. Your risk is going to be $100. Okay? Or about 20 to 25% on your contracts. Remember what we talked about before. If you were to break down or the trade wasn't going to work, you would lose 10 to 20%. Okay, that will be your risk. Okay, and your reward is you want to make a minimum of $200. As PB previously mentioned, right, that's about a 2 to 1. Now, on a $5,000 account, you can have a little bit more flexibility. Small accounts, you don't have flexibility. The larger account is the more flexibility you have. Unfortunately, that's just the nature of the business and of trading. But this will prevent you from blowing your account. But now let's talk about a $5,000 account. If you are new, okay, and you're just placing your first options trade, you're going to use a $1,000 position size, a $200 risk, okay, and your reward is going to be $400. Okay, so what does that break down in terms of numbers? So your risk is going to be 20% and your reward is going to be 40%. Okay, so quick math tells me that is about a 2 to 1. Now, if you're more a seasoned vet and you have a little bit more comfortability trading and you know your setups and things like that, like you can use $2,000 and you just use the 400 and 800, especially on like a trend day or things like that. You can definitely feel free to size up. That's only if you're experienced. And when I mean experience, I mean minimum of 2 years in the market. Okay, but for anyone starting out, $1,000 is best. Why? Because this will allow you, so say you have a $1,000 position size. Okay, this will allow you 5 trades, okay, per day on your account. Okay, 5 trades. That's a lot of trades. Most traders take less than 3. So you have plenty of wiggle room. And when we get into more advanced strategies and things like that, we'll discuss later. You can really take this 5 trades and stretch it and, turn this 5K account into a 10K account. So general rule of thumb is, 25% of account per trade with a risk reward of 2 to 1. Now you're probably asking, Elliot, this is a boot camp. Like, why are we talking about a $100,000 account here? Like, that's just kind of ridiculous and not the right audience. Well, here's the thing. My goal is, and PB's goal is, for you eventually to have a $100,000 account. And I want to propose a question to you. How many times have you seen on Twitter, we'll see someone have just something crazy, like $50,000 in a trade, and you're thinking to yourself, like, holy shit, like that's a lot, right? But if he's buying shares with this, right, or even options, do you really think he's going to let this $50,000 go to zero? Unless it's Wall Street bets, probably not. And I just want to show you this with shares just because it's easier to kind of demonstrate. It's like, say a trader takes $25,000 worth of a stock, okay? A new trader might think, oh my, like he's risking $25,000. Like that's a lot. Like that's a Honda Civic or a new Toyota Camry. But what if I told you they're just risking $1,000 and the reward is just $2,000? They're not expecting this whole entire position size to go to zero, okay? Because they have a stop loss. Now, if they were gambling and things like that, sure. But I just want to show, because I always think it's interesting, right? When I first started trading, like I would see someone have like $100,000 in a trade and I'd be like, oh my Lord, like that's insane. But a stop loss, if it was 10%, it would only be like 10K. And then I'm like, oh, okay, it's really not as scary as I thought. But it goes back to what we said previously, where this is a risk-based business. If you didn't have a risk-first mindset, okay, this 100K can easily turn into zero without any proper risk management, strategy, nothing. Okay, let's talk about my favorite thing in the world, and which PB hinted at, is the math behind runners. The math behind runners. So what is a runner? Okay, I think there's a rap song where it says she's like a runner, she's a track star, right? I don't know the name of the song, but you get the idea. So what is a runner? So a runner is, we call these like your lottos, okay? Or your flex, right? If you're a social media person and you want to show your friends, like, yo, look at this trade, I made, 500%. Like, no one in their right mind is actually holding the entire position for 500%, okay? They're flexing and they're leaving a runner. So let's do some math. So let's say we took 3 contracts at $1. Okay, so that means our position size is going to be about $300. Okay, and think about this. This ties in directly to the small account. So this is what you would do if you have a $1,000 account. Okay, and now I'm just going to draw it real simply. Let me make this bigger so you guys can see. So here's the stock chart. Okay, we break out, we come back down to our key level retest. So we'll just write PMH for pre-market high, and then the stock decides to rip, and we sell our first contracts at high a day. Okay, our first contract. So let's say we sell two contracts, and we sold them at, I don't know, $1.40. Okay, we sold them at $1.40, or around 40%. How much money did we make off of this trade? Okay, for these 2 contracts, we made about $80. Okay, that's pretty good. But you're probably asking, well, Ellie, we had 3 contracts and we always sold 2 contracts. What about the last one? See, so that is where the runner comes into play. So what you're going to do is, as the stock keeps ripping, okay, you are going to hold a runner, and your stop loss is going to be the 9 EMA, okay, or the 8 EMA, whatever one you want to use. Doesn't matter. The concept is still the same. And if you remember, up here, we talked about what is the exit plan. Okay, so here's an EMA exit plan. So if you're following these rules, you know that you're going to exit when the 9 EMA breaks. I hope you're seeing how this all ties in together. Okay, so your exit plan is going to be that. So once it breaks the 9 EMA, you're going to sell. So let's just go back up to here, just because this one's a lot cleaner, okay, and say that we sold our 2 contracts right here because this was the high a day, and it kept ripping. So remember, we sold our contracts for 40%. What do you think our contracts are going to be once we break the 8 EMA or 9 EMA over here? They're probably going to be like 200%, right? Just say it's a Lotto Friday. Okay, so say they're 200%. Let's talk about the math behind that. So let's go back down, and let's say our last contract we sold for 200%. So that would be, what's 200%? Like $3? Oh man, I can't do mental math in my head. Let's just do 100%. Okay. So the contract went 100%, so it'd be at $2. Okay, so 100%, and we netted $100. But I want you to notice something here. Okay, I want you to notice something. For one contract that we have, we made more money than the 2 contracts we sold earlier. You see that? The 2 contracts we sold earlier. Now, okay, so we lock in $80 of gains on this trade. Okay, how much did we pay for this last contract? $100. But we already locked in $80 worth of gains. So now our basis is actually $20. See how that works? So now we can let this runner go as crazy as we want because we already paid for $80 worth of that contract. Okay, so you can let that thing go crazy. I hope you all understand that, because this is extremely important. Now, let's go into practice on how this actually works. So here's actually a recent trade that we took. Okay, so let's talk about it. So we can see this is the pre-market high here. All right, so this is a bull flag. Okay, on the pre-market high, the retest. My line's off because I have shaky hands. It is what it is. So what do? We sold the high day. So let's say we sold our 2 contracts. Okay, but then we have 1 runner. Okay, so here's a screenshot here. Notice how it went 100%. So we sold high a day, but then we left it until the 8 EMA or 9 EMA breaks, which it did right here. So now, if we look at our example up here, just leaving it against the 8 and 9 EMA, we made 100%. So every 1 contract you bought, you doubled your money. And Tesla is quite expensive. I believe these contracts are about $3. So these contracts now went to $6, okay, for $300 in profit off of 1 contract. Okay, now let's say that you missed this first move here. Okay, you missed it. All right, well, let's look at it. Tesla then formed another flag right here. Let me zoom in so you can see another flag right here. So you would enter off this bull flag. Okay, you would sell the high a day. Okay, sell your high a day, get your 20%, right? Get your basis down. Make those contracts on the house money, right? On the casino, aka the market makers. And look what happened. Your contracts went, did it break the 80 May here? No. no, 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 no. And then eventually it did break right here. So contracts from here to here on a Friday went 400% minimum. Okay. And now you have a small account. That is how you grow it. So people always say, like, I keep missing the move. I keep missing it over and over and over again. Like they're so happy to see, they think of the model, right? It's like see green, take green, but there's a way to do see green, take green appropriately. Okay, so lock in at the high of day always, but if it really starts moving and shaking, just keep some. Let it work. Okay, just trust the ADMA. As long as it holds, you're going to hold. As long as the trend holds, you hold. It's really that simple. Traders often, they're looking at the candles. Well, it's this type of candle type. It's like you're looking into it way too deep. Keep it really high level and really simple, and you will make much larger gains. So finally, to wrap everything up, is the goal is to always get the runners risk-free. The house money. Think about when you go to the casino, okay, or anywhere, and say someone, you go to a casino and you make $1,000, okay? You make $1,000 at the casino off one hand of blackjack, okay? This is all casino money. So you can let casino money do whatever it want because it's not money that's actually in your bank account. It's a couple poker chips in your pocket. It's the same thing when it comes to options trading. It's poker chips in your pocket. It's not real money until you press sell and you eventually leave the casino or get off your phone or off your computer or whatever. That is the key. It's house money. Let it work. Because when you get trades like this, which recently have been happening quite often, you're making 400 or 500% off one contract. I mean, that's $1,000 on a small account. So now your 1K account becomes 2K account. And when you think about house money, just think about this example up here. So here's your two contracts. You lock in your $80, okay? And now your last contract, your basis is now only $20, right? And then that is how you go. So thank you for having me as always, and I hope this helps you. And cheers. See you guys on the other side of the profitable trader journey.
That's fire. Well, guys, Ellie just gave you literally everything on scaling and exiting, position sizing, in general entries and exits as well. I want to go over one thing really quick. I want to go over 2 trades. So here we see this in the video. I just want to go over some examples. Pre-market high retest. Be pre-market high, retest number 1, retest number 2, both A+ retest. And the first one is better. So the first retest is usually gonna be better than the second one, guys, because the second one you already rejected some type of area, especially when you rejected high of day 3 times. But this is another example of potential entries. Also, when it gets close to VWAP, it's good. So here we have 2 retests. First one worked, second one also works. Tesla, I lost in this trade on yesterday. So we have, check this out, pre-market high. We have retest number 1. This one would have worked, right? Then we have retest number 2. I took this one and I lost. I had to get out on this 5-minute close under the retest. Look what happens. You come back up, you reclaim it. You have this 3-bar play on VWAP, consolidation, and then a rip. It's unfortunate, but it happens, guys. There's going to be times where it loses, and you just need to know when to get out. So I literally entered it, and I got right out on this 5-minute close under. Small loss, but that's okay. Small losses and big wins, that is how you'll be profitable in the long run with this strategy. Today's class is super, super important. We're going over trading psychology, trading emotions, why most traders fail, how to journal your trades, and how to have proper consistency with your trading. So it's going to be a really, really, really important video for you all. And I just need you guys all to sit back and listen, understand what we're saying, take it in, and really think about it. Think about what we're about to tell you guys, because these mistakes, these psychological mistakes, these emotional mistakes are huge reasons on why traders don't make it. That's the truth. So I'm going to start off with how to manage your emotions in trading, what you need to be careful of with your emotions, the biggest emotional mistakes people make, and then I'll be going into journaling, and then Ellie's going to do some consistency and discipline. So guys, managing your emotions is super, super important. And a lot of people tell you you need to have 0 emotions in trading. But the truth is that's impossible. You're not a robot. You want to try and get as close as you possibly can to becoming a robot. But you're always going to have a little bit of emotion involved. You're a human being. It's part of us. But what you need to avoid is, it's okay to have emotions, but what you need to avoid is emotional traps like FOMO, revenge trading, thinking, not being consistent with what you do, saying, oh, this happened last time, so now I'm gonna do the opposite. Like, no. This is where most people mess up. Thinking every time I sell, it goes up. Every time I don't stop out, it goes right down. Every time I buy, it goes down. Every time I hold, I get screwed. This, that. That's all BS. That is all BS. What you need to do to avoid that emotional trap is you need to stick to your plan and stick to your system. In the long run, I promise you, if you do the same thing over and over and over again, you're going to make it. So think about it like this, and most people know this. It's like in blackjack, right? In blackjack, if you have a 16 against a 10, and then you hit one time and you bust, and the next hand you get the same exact hand and you stand it, and you would have won, you would be pissed, right? But in your head, you're thinking, I hit it last time, I'm going to stand it this time, blah, blah, blah. That's BS. You need to stick to what you're doing. So if you're selling every single time a stock hits a psychological level or hits your target and it keeps going more up, that's okay. You need to stay consistent with what you're doing. Because in the long run, statistics show that if you stay consistent with what you're doing, you stay consistent with your game plan, with your system, you just do the same things over and over and over and over and over again, you have a much better percentage, you have a much better chance of becoming a profitable trader. So with that being said, there's other things you need to avoid with your emotions. There is the fact that when most people are down, this is how you have your biggest days, is because you're trying to make back a loss. This is called revenge trading. This is how you blow your account. In order to avoid revenge trading, you need to set a number in your head. So for example, it's called your max loss. So when you get down a certain amount of it in the day, no matter what, you sell. And this has to be an amount that you're okay with losing this amount in a certain single day. You're okay with it. So for me, like I won't lose more than like $1,000 or $1,500 in a day. My max loss is $1,500. I will not lose more than $1,500 in a day, and I will not take another trade. If I take more than 2 red trades in a row, I stop trading. And I take at least a 20 to 30 minute break in between my trades if I take a red trade. So there's these rules you need to have in place so that you can avoid revenge trading and you can avoid these FOMO actions. And one thing that messes up a lot of people also is you're in a losing trade. You want to average down into your trade, but think about it. Would you rather buy more of a trade that's losing or buy more of a trade that's winning? Your emotions are telling you it's cheaper. But the chart is telling you it looks like shit. But most people listen to their emotions and they buy when a stock is going down. They average down, which is horrible. If anything, you're going to want to average up. If a stock's looking great and you're in a position, you should buy more, right? This is where your emotions get you. You end up adding back in when if you're better off, instead of averaging down, if it gets a huge average down that's not a part of your plan, you're literally bettering off looking for a better trade that looks better. Because there's so many opportunities in the market. And if the opportunity you picked isn't working out, that's okay. The best trader is not the best at winning. The best trader is the one who's best at losing. So if you want to become the best possible trader, if you want to be profitable, if you want to have those 4 or 5, even 6-figure days, you don't need to be the best at winning. You need to be the best at losing. You need to be able to accept your losses. You need to be able to feel the same type of way when you lose to when you win. There's 3 types of winning trades in the stock market. There's winning trades, there's big wins, there's small bit wins, and there's small losses. Those are all winning trades. As well as break-even trades are also winning trades. So 4. 1 second, guys. So, guys, recap on emotions. You really want to avoid the emotional traps. You want to avoid revenge trading. You want to avoid the what if, the should have, would have, could have's, all of that. You need to stay consistent with what you do. You need to try and act as much as a robot as you possibly can. Think about it like this. You're just sitting at this desk. You're waiting for something to happen. When something happens, you press buttons. And think about like this. You have commands in your head that if this happens, you click sell. If this happens, you click buy. There's no in between. There's no I don't think it's gonna bounce back. There's none of that. It's if this, then this. And if this, then this. You need to have built-in commands in your head, and you need to trade strictly solely off those commands. And when you take those emotions, when you take the psychological aspect out of trading, you're going to go so much farther. And one thing I want you guys to think about is like, when I started trading, I made the mistake of, I'd see everybody on Twitter talking about a play, and I'd be like, oh, this has to work. Everyone's talking about it. But let's go deeper into that. So if everybody's talking about a trade, what's the percent of people that are profitable traders? Some people say 97% of people aren't profitable. Some people say 99%. Let's say 97% of people aren't profitable. So would you want, if 97% of traders are unprofitable, would you want to be on the same side as everybody else? Would you want to be in the same trade as everybody else? No, I'll answer that for you. You don't want to be in the same side as everybody else. Why would you? Why would you? When you see everybody on the same trade, on the same side, there's two things you could do. Number one, run. And number two, run. So now that we went over emotions, trading like acting like a robot, stuff like that, I want to go over journaling and how it works. So before I share my screen, journaling, just a brief overview on the point of journaling. Journaling allows you to adapt your strategy. It allows you to make your strategy better and better over time. And the market moves in cycles. The market is always changing and adjusting, and journaling allows you to adjust your strategy with the market. So you may say, PB, what do you mean by that? So the whole point of journaling is, think about it like this. When you have a pencil, after you use it for a long time, what do you have to do? It gets dull. You have to sharpen it. Same thing with your trading strategy. You need to continue sharpening your trading strategy. You never want your trading strategy to get too dull. So by sharpening your trading strategy, by journaling your trades, this allows you to make sure you're always in your A game. Your pencil's always writing the best. Your trades, your performance is always the best. So let's go over exactly how I journal. So journaling 101, team. First off, this is what you want to do when you're journaling. You want to recoup your trades. You want to go back. You can go back however much you want. I think the more you journal, the better. I think you should journal every single week, every single month. You should do a bunch of different journaling. So you could do weekly, you could do monthly, you can even do daily, okay? But what you want to do is you want to gather all your trades. So gather all your trades. Say we're doing for the week. Gather all your trades. I was just say month. Gather all your trades for the month, and you need to mark down a few requirements, okay? You want to look at the day. You want to look at the time of day that you entered it. You want to look at the stock. You want to look at the setup. You want to look at the expiration of the contract. You want to look at this. You want to look at the day, the time of day, the stock, the setup, the expiration, and you also want to look at things like, okay, how far out was my strike? Did anything happen in my life this day? Your mood. You want to look at things like that. You want to look at also when you're journaling, did I make any mistakes with this trade? So after you have all these down, so you marked down the day you took the trade, the time of the day it was, the stock it was on, the setup it was on, the expiration, how far out your strike was, did anything happen, blah, 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 did I make any mistakes in this trade? Once you mark these things down, you want to look at it and you want to say, okay, so say you took, let's do a test journal. So say you took, let's go, SPY, say you took 5 trades on, okay? Say you took 5 trades on SPY. You took a trade, you took 3 of them at 9:30, then you took 2 of them at 10:30. Say these are all losers off the open. And these, you had 1 winner and you had 1 loser. What are you going to tell yourself? You're going to say, okay, first off, I probably shouldn't trade SPY. Second off, I should not take trades at 9:30. Trading the open isn't for me. I had a 0% win rate at 9:30. and I had a 50% win rate at 10:30. I'm only going to take trades at 10:30. Now let's go deeper into it. So say you traded SPY. SPY, we know you're 1 for 5. Say you traded Apple, Meta, and Tesla. Say you want 3 for 5 on Apple. Say on Meta, you also want 3 for 5. And say you want 2 for 5 on Tesla, right? But let's say on SPY, your average winner was 200, your average loser, 100. Now, Apple, you were 3 for 5, right? And say this same thing. Average winner 200, average loser 200. Average winner 200, average loser 100. So right off the bat, we're not trading SPY anymore. We're going to take the Apple. Say Meta was the same thing. You had a 1 to 2 risk reward. But now say Tesla, your average winner was only $50 and your average loser was $200. Even if this number right here is 3 for 5 and your average winner is $50, your average loser is $200, we are not trading Tesla anymore. So now after journaling, we figured out that we're only going to trade Apple and Meta because with Tesla, our losers are too big. With SPY, we have a bad win rate. Both Apple and Meta, we have a proper risk to reward and we have a good win rate. So let's go deeper into it. Now, say with SPY, let's say you took, so let's go through like this. 0 DTE trades versus weekly trades. So you're reviewing the month, you're reviewing the strike. You took 20 0 DTE trades. Let's say you want 7 for 20. Say here you want 12 for 20. But with 0 DTE, your average winner, your risk to reward was 1 to 1. With weekly, you had a 1 to 2.5, meaning $10 losses to $10 wins. But this one's $10 losses to $25 wins. This is telling me right now, I'm not trading 0 DTEs anymore. And I'm bringing this up because I had this happen to me last year in 2024, where my 0 DTE trades were losing more than my weekly expiration trades. So what did I do? I basically maybe traded the indexes 3 or 4 times last year. I barely traded the indexes last year. I barely traded any 0 DTE and SPY or Qs because I was understanding, sure, I was winning, but my losses were a lot bigger than my wins. So I cut it out and I stick to only weeklies on individual names that I can find relative strength and weakness. So guys, the end of the point of journaling is we're getting all this data and we're figuring out what works and what doesn't work. We're cutting out what doesn't work. We're sticking to what works. So we're basically just going all in on what works. It's great. You're cutting out what's literally holding you back in your trading. That is why journaling is so important. And I hope this helps you understand, journaling, you're just going through your data of your trade and you're seeing what your losses have in common, what your wins have in common. You're cutting out what your losses have in common and you're doing what your wins have in common. With that being said, Ellie, it's all you.
All right. Thank you. And guys, if you're not journaling at this rate, you got to journal because you're not going to know what you're doing wrong if you don't journal. A lot of people, when they get into the journaling space, they just kind of, oh, I did this and this. I'm like, no, what really happened? So you probably heard before sometime in your trading career, or if you're brand new, you haven't heard before. But all about emotions when it comes to trading. Unfortunately, I wish I could have Elon code a Neuralink to go into my brain so I could take the emotions out, but we're not there yet. Maybe in the future. All right, tough joke, but okay. So building emotional discipline. How do we do this? All right, how do we do that? It's all about our trading process. And I'm actually going to show you my exact process so you can walk through it. And again, feel free to copy it. I find that a lot of traders, when they actually have a set process of how they're going to look at charts, set things up, set their alerts, et cetera, they have a higher win rate because they come to the market prepared. Okay, so what is my process? So every single Sunday, minimum for 2 hours, I look for setups. And what does that mean? Right? Basically, if it's football season, I'm watching the football game, go Birds, right? Just going through charts. What looks good? What looks bad? What looks tradable? Right? You don't want to be sitting in a chart that's making squiggly lines across the screen. You want to find those big, clean breakouts that have bases or big breakdowns that are now retesting key levels. So you want to get like a collection of those. And you don't have to do this on Sundays. Most traders will tell you that their weekday starts on Sunday. However, you can also do this at nighttime. But the plan for this is you just want to know what the dailies are doing, because not every day a daily is going to give you a signal to hop in and make money. So what I do is I set price alerts. And what I mean by set price alerts is, say that there's a stock, we'll use this example up here, is retesting 100, which is like a key psychological level. I'm going to set a price alert there. You can do it on TradingView. It's free, of, hey, we're touching 100 again, just so I'm constantly having an eye on the market and what's kind of going on. Because what happens is there's so much craziness in the markets that you really miss those, we call them the fat pitch layups, like the easy jump shots to win the game and start building your account. So that's my process outside of the market. Let's talk about when the market actually opens. So I'm going to switch the colors here just so it looks prettier. So every single day you want to wake up 1 hour before the market opens. Why? You can't just wake up at, if you're on the East Coast, right, 9:29 and expect to start trading, because you want to see what's moving. You want to take time to digest. You want to take time to also wake up. Trading is by nature extremely stressful. So you want to make sure you're nice, relaxed, calm, and prepared as soon as the market opens. So that's why I recommend traders wake up 1 hour before the market opens. Now, if you have a job or anything like that, maybe listen to like a morning show or something like that that's talking about stocks, right? You always want to keep having your mind around stocks just so you're aware of what's happening, headlines, things like that. The easiest way to do this is to scan a watch list. So we've shared many times. I recommend you watch a video on PB's YouTube called How to Find Stocks to Trade. We literally teach you how to build a watch list, and it makes it really easy. It'll maybe take you 30 minutes to watch the whole video and then build your own watch list. And every morning you're going to wake up and you're just going to go through the watch list and just focus on a few names. What I find is traders, right, they'll have like 100 names on their watch list. They're watching everything. That's not right, because you want to make sure that you're looking for that fat pitch. Okay, there could be 10,000 setups, but there's that one that'll take your small account or medium account to a large account. And those type of setups you really want to focus on. And again, if you follow the advice up here of setting alerts, you can also make your alerts go off pre-market if you want. So you'll know if a stock's above a daily breakout. You really wake up with a notification on your phone. You don't have to do any guessing. That's a little bit more advanced for beginner boot camp, but it's something you can do if you're definitely more experienced. Now, the most important part, creating a trade plan. What is a trade plan? Let's do if A, then we're going to do B. Okay? If C, then we're going to do D. It's really that simple. So that's what a trading plan is. It's just covering your bases, okay? There's 3 ways this trade can go. You want to make sure you've thought of all 3 ways. That way, you're prepared to whatever comes to you, and all you have to do is just follow your plan. If you have a plan, okay, say I give you a treasure map and I said, hey, all you had to do is go to this beach and dig where the big X is, and you're going to find treasure. Just walk down the beach and dig in the hole. You're not going to have emotions or anything like that involved. This removes all of your emotions, okay? Now, how do you actually build one? You probably hear it all the time, but what does it look like? Has anyone actually provided you with a trade plan? Well, here, I'm going to do it right now. Exactly what I do every single morning. So we talked about in step 1, okay, is scanning for stocks. So we can see that we have the NVIDIA daily chart, okay, and it's forming a bit of a flag or a channel, however you want to read this. So we know if it breaks down here, it's going to go bearish. And if it breaks up here, it is going to go up. So we're going to buy calls here and we're going to buy puts down here. So we know this setup is coming. We know this setup. We scanned and we have it charted. You can use set alert if you want. Okay. So now what do we notice? The next day, okay, NVIDIA actually breaks out. How do we know that? Because if we look at a pre-market, we can see this little diagonal line down here. That is this diagonal line right here. Okay, so we know it's above. It's above the daily breakout. NVIDIA is up pre-market. What is our trade plan? So there's 2 ways that this trade plan could work out, but we need to take in the big picture and everything that's happening. Step 1 is, what is the trend? Okay, so ignore all the indicators on my screen. What is the trend? If I draw an arrow like this, is NVIDIA going up or is it going down? Clearly, it's not going down. So let's just erase that. Oops, there you go. So we can tell what is the trend. So first question you want to ask yourself every single day is, what is the trend? So the trend is up. Okay, and if the trend is up, that means we are going to buy calls. So that's step 1. Step 2 is, where is it relative to your levels? Remember, this is the pre-market. So we can see, okay, right before the market opens, this is also a 5-minute chart, by the way, we can see that NVIDIA is opening at the highs. Okay, it's opening at the highs. So that means it has a lot of interest in this stock. Okay, there's a lot of volume, there's a lot of momentum, the trend is up, it's above the prior day high. Okay, so what is our trade plan? Our trade plan is if it breaks the pre-market high, okay, which is this candle up here, we are going to buy calls. Okay, and if we miss the pre-market high, we're going to look for an area of consolidation or something like that in order to, again, follow our entry and exit strategy. When we talk about EMA tabs, that is what we're going to do. So that's our trade plan. Now, if NVIDIA doesn't break the pre-market high, we're not going to trade it. Okay, if it doesn't break the pre-market high, we're not going to trade it. So there you go. There's our trade plan. And now what actually happens? NVIDIA breaks the pre-market high and goes up. So we buy calls here, and these calls went well over 100% because it was a Friday. It's really that simple. So that's your trade plan. If you came in here saying, oh, well, you know, NVIDIA tests this level that I don't have, or if NVIDIA breaks the 80 EMA, I'm going to short it. It's no. Above the pre-market high, above the previous day high, it is a long. You're going to buy calls. Trend is up, everything's up. You just buy calls and make money all day. So that's how you make a plan. Just look at it, okay? From watching this boot camp put together, okay, did it break the pre-market level? If it did, check mark. Okay, is it trend up? Check mark. 2 good reasons to enter a trade always, and both of our reasons tell us to buy calls. And there you go. Broke the pre-market high, the trend is up. This is an 80 EMA or a 90 EMA, whichever you prefer, and you made 100%. So what if your trade plan said, oh, if it breaks the pre-market high, which is all the way down here, okay, but you missed it. You had work, you had to take the kids to school. Well, what do? If you recall, if you go back in the recording, we said we're going to look for a tight area of consolidation in order to enter off of. Now, we missed it because we had to drive the kids to school. That's fine. When a stock is moving very violently and very fast, okay, and has a lot of interest and it's breaking out of a daily, blah, 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 you get the idea. We can always find another area of tight consolidation. So, is there tight consolidation on any of these candles here on the left? No, it's going straight up, okay? So we can't justify an entry there, right? Because we buy up here, we have to assume that risk-based mindset is going to come all the way back down and make us lose money. But we can see on the video, just kind of resting in here. Now, if I just draw something like this, all right, and another part like this, so it's just kind of resting. This is a bull flag. So the video is flagging out, and that is what we always look for when it comes to another entry. Again, we had this already planned out. We don't have to guess on where we're going to enter. We're going to enter, breaks out the flag, off the 80 EMA or the 90 EMA. There's your entry right there, and you're going to sell always at high a day. And that is it. So you missed the big move off the open, had no fear. You still made 50% up here. That is it. Notice we had both areas covered. And now if you were able to hit the pre-market high, you could even take some of that money you made off that first trade and put it into this flag and stretch your gains. Hopefully, from this example, you see the importance of a trade plan. If we were just like, oh, NVIDIA is going to put in an ugly candle because it's too high, you would have shorted it here and had a really bad day. So something I always thought was funny is I had a mentor tell me once is show me a trader and I will ask them, okay, their process. What is their process to trade? And that's exactly what we just demonstrated here. Me and PB both follow the same exact way when we scan in the morning. It's very easy. It's very consistent. And that leads me into that next point, is maintaining consistency. So I find that, you know, traders will jump strategy to strategy like the new fad, right? It's like, oh, they like this way, then they like this way, and then they like this way. And then as soon as they lose with one strategy, boom, they go to another one. They say, oh, that strategy sucks, or that strategy stinks, or that strategy is not for me. But they never even gave it a chance. So trading is a game of probability, okay? I take losing trades every single week. Okay? Every single week. But I also win every single week. So you just have to win more than you lose. That is it. And you've probably heard this like 1,000 times already, but you have to have big winners and small losers. And we covered that in the exits class as well, and exactly how you can make sure those losers are small and make sure those winners, cough, cough, hint, hint, runners, okay, will make sure that you win more than you lose. So, as I mentioned, is I take trades that don't work. PB takes trades that don't work, but we lose like 5-10% of them. Like that means nothing. It means nothing. So what do you do? If a trade doesn't work out, what do? You just have to dig into the why, okay? The why it didn't work. Why did it reject that level? Why did it not hold? Why was it a long entry? Why did I get stopped out only for it to go to the moon? Why is the discovery in how you maintain consistency? The why, okay, diving into the why is what's going to make you be like, hey, I'm not actually crazy here. Like, there was something that stopped me out here. And as you develop a journal and as you go through things that PB just said, you're going to discover what that why is, and you will prevent it for the future, which then, if you prevent why this went wrong, your wins will be more, okay, than your losses. One of my favorite quote is 90% of traders don't make it because they run out of money. Okay, it's not because they don't know how to, they didn't have a working strategy. No, they run out of money every single time. They take an account, it goes down to minus, I don't know, $1,000. That's all the money the trader has to their name, and the trader never comes back to the market. They run out of money and they give up. All you have to do in trading, as I can't stress enough, is keep your seat at the table. Okay.
So guys, now that you know all that, I really urge you guys to go create a trading journal. Journal your trades. If you use journaling software, whatever you want to do, but please take what we're telling you in this video and take it seriously. If you enjoyed, then make sure you go join the free Discord below. It's 100% free. This bootcamp has been insane. And tomorrow, day 7, is going to be super, super important as we're going to be wrapping everything together. In this video, we're basically putting everything together, going over your trading plan, scaling your trading to how do you scale, how do you make sure you continue on a consistent path, when do you know if you want to become a full-time trader, watch list building. Like we're just going to be putting everything together, guys, giving you guys reminders and stuff like that. So first, starting off, I want to go over you're being prepared for the market. So let's just do a recap. You should scan the market, scan the setups every single night, every single Sunday, and ideally every morning. Every morning and every Sunday is the best, and if you could every night, it's awesome. But every Sunday, you're gonna be looking for top setups that look good. You're gonna be marking it down all your levels. You're also then going to be going and saying, okay, now that I have my levels marked down, are there any chart patterns in the chart? I showed you guys a bunch of chart patterns. You're gonna look for those triangles, ascending triangles, those flags, those gap fills and stuff like that. Look for those, mark the levels down, be prepared for the market. And then every morning you're looking for stocks that are up the most, down the most. You're looking at if any of your setups from Sunday are looking good in the morning. And if they are, that's really, really good. That's really, really good. Today, today's Monday. Yesterday I was scanning the setup MU. And what ended up happening was MU, it was a stronger stock today. I traded the retest about key area and I got a sick trade on it. How did I catch this trade? Because I was prepared. I did my research on Sunday and I traded it on Monday when it was the strongest stock today. So guys, you need to stay prepared. And don't think you're gonna wake up 5 minutes before the market opens and be a profitable trader. You're not. You need to be prepared. You need to be scanned and you need to be in the proper mindset. What are you doing? You're waking up 2 minutes before the market open. You're tired. You're in a bad mood. No. You have to be ready, be energized, have confidence in yourself. These are all little things that people don't think about, but you need. You're not going to be a profitable trader. You're not going to be part of the 1% waking up 1 minute before the market open. You're just not. You're waking up 1 minute before the market open. You don't know if there's any major headlines. You don't know what stocks look good, what stocks look bad. You wake up, you take a trade off the open, then you're really screwed because you have no defined levels, no defined pre-market levels. What if there's a different stock that's stronger than that stock? What if this stock had news? You didn't do your research on it yet. You're setting yourself up for failure. So that's really, really important, is having that trading plan and, building your watch list. So remember, with watch list, moving over how stocks move level to level, that is very, very important. So this reminder, stocks move level to level. There's no random price action, none of that. Stocks move level to level, and you need to mark down all those levels. Don't guess where stock's gonna go. There's no guessing. We don't guess, we react. That's really, really big, and that's where I think I'm very different than a lot of people. A lot of people predict. They think, oh, I think Tesla's gonna rip the next 3 weeks. Tesla could rip. Tesla could dip, Tesla could chop. I don't care what it does because I'm not going to predict. I'm going to react. in trading, I said this yesterday, but I'm gonna go more on it today. You need to just strictly be off reactions where your mind is like a command center. If this happens, then I do this. If this happens, then I do this. And that's it. That's the only way you'll make a decision is if this, then this, if this, then this. And I know there's probably some of you guys who are paper trading out there and you don't know how to go from paper trading to regular trading. So I wanted to give you guys some tips. Like if say you have like, I don't know, $2,000 saved up, it doesn't mean you put all $2,000 in your trading account. No. Maybe put $500 in your trading account or $1,000, but do not put the whole amount because most traders blow their first account. Well, that's okay. It's a part of trading. On that blown account, you are going to learn so much. I hope you don't blow any accounts. With what I've seen is most traders blow at least one account when they get started. So be prepared. Only put in an amount of money that you're okay with losing. You understand that you can lose this money and only put it if you lose that money that it won't affect you. So make sure that's something really, really, really big. On top of that, there's another aspect where people say, PB, what if I don't want to trade your strategy? That's okay. This is where you want to paper trade. So if you want to look for a new strategy, that's okay. You don't have to trade my strategy. I just like my strategy. I know my strategy works and it's what works for me, but it might not work for you. So what you want to do is back test. You want to go on paper trading and you want to test out different strategies, see what you like, see what you don't like. Go for the previous month's data on the stock, what the strategy you're going to use, and see what the win rate would have been and what your average loss compared to your average win would have been. These are things you need to do. Like it's not just like you wake up in the morning and you press buttons and you make money. Yeah, sure. Like once you get very, very experienced and profitable, it gets somewhat to a point like that, but there's always a huge battle. So it's not as easy as people make it seem. Trading is one of the hardest ways to make easy money. It is. You spend years and years literally fighting against yourself. It's a mind battle against yourself to then hopefully eventually learn a skill that's going to make you can't even put a number to how much money you can make with trading because there's no limit, which is why I truly believe it's the best. So that's just another thing I wanted to go over. And another thing is like, there's going to be times where you want to stay away from being blinded from the money. Like you don't want to put a goal of making $5,000 a week or $500 a day or $1,000 a month. Don't do that. Set your goals based off performance. Please set your goals based off performance, guys. That is going to be so important, is set your goals based off performance, not all based off money. If anything, try to take the money out of trading. He's a very successful person I know, and he told me this the other day. He was like, PB, let me teach you something. It's the best piece of advice I can give to you. This guy's worth 9 figures. I said, okay, what is it? He said, don't chase the money, let the money chase you. And he advises me, I think, what do you mean? That's just stupid. Don't chase the money, let the money chase you. But what does that actually mean? It means that when you're trying so hard to make money, like when you're just full focus is on making money, the money is not going to come. But when you focus on actually being the best at that skill set, what's going to happen is the money's going to chase you. The money's going to come naturally. Think about it like this with a business. Look at the biggest businesses in the world. These businesses weren't made for the sole purpose of making money. These businesses were where people saw a problem and they found a solution and they monetized off of that solution. You will have the most successful businesses not when you're trying to make money, but when you're trying to solve a problem. When you're creating something that people need. So that's something to always keep in mind, guys, is like, I don't even know traders who they turn their P&L off. They don't look at their P&L in the day. They trade, and whatever the P&L is at the end of the day, it doesn't matter. Just trade. That's it. And that's pretty smart. If you get blinded on money, do that. Another thing that happens is like you see traders and on Instagram and Twitter, they're showing these huge gains. Don't get blinded by that, because what that makes you feel is like, oh, that could have been me one of those days. I'm going to go heavy. I'm going to start gambling with my trading. I'm going to get a huge home run. I'm going to have one of those days tomorrow, and it's going to blind you.
Stay consistent, and I promise you in the long run, you will have those days, but you need to stay consistent and you can't try to have those days. They're going to come naturally. Another thing, guys, is I say this over and over and over again, like just because there's huge moves in the market every single day. And one of the reasons I see so many people accounts is they're trying to catch every single move, trying to catch every bottom, every top. No, it doesn't matter. My goal is to find a system where I can catch chunks of some moves. I don't want to catch every move. I don't want to be at my computer for 10 hours a day just trading. I don't want to. That's the truth. I don't want to replace a 9 to 5 with a 9:30 to 4. No, my goal is I found a system. You guys have a system. And our goal is to kite and monetize off of catching chunks of moves. I just want to catch a chunk of it on my goal. I'm not trying to catch the exact bottom or the exact top. I'm trying to catch the pre-market high retest to the new high day. That's my chunk, and that chunk added up turns into a lot of money. A lot of money. So I'm going to come back here in a little bit, but if Ellie wants to give any last thoughts or tips, I'll let him do that now.
I think you put it beautifully, where people come into the market and they want to make X amount of money. Oh, I need X amount of money to quit my job. Or the biggest thing when it comes to trading is the dollar amount, right? So for example, let's take an individual. We're going to say this individual, they had $5,000 in their account. Okay, this is what they started with, and now they're down to 1K. So what do? Every day they approach the market and they said, well, I did have 5K, but now I only have 1K. And when I say that, the first thing that subconsciously prints in the back of your mind is, I got to make it back. And I've seen this, right? I've taught hundreds of students over the years. I went through this myself, right? And what happens is they always want to try to make it back. But this is what happens. You lose those 1K because you're chasing this 5K. And now you're down even more money and more money and more money. And what happens is I've had traders come to me where they're down $70,000, right? 70K. Okay. So no matter what trade, say they take 3 contracts, okay, and they make $50, subconsciously, they're going to be like, it's not enough. And every day they come to the market, they say, it's not enough. You get the point. And what happens is they're wiped out. I've seen this so many times. So our goal, especially with the boot camp and everything we taught, is, hey, let's just avoid blowing up accounts. Let's just practice learning a good strategy. Okay, who cares if we're break even or we lose like $1,000 our first year, right? That's better than losing 70K. If you can keep your losses small during your learning period, especially by taking this boot camp and studying a lot of the EDU we put out, you'll really, really be able to scale. Okay. Making back 1K, okay, is much, much easier than making back 70,000. Our goal, as I mentioned before, is to always keep our seat at the table. Okay, 90% of traders don't make it because they don't know how to trade. They run out of money. And that's the biggest thing I see. Traders come in, they have X amount of money, they want to double it, triple it, quadruple it, they lose it all, and boom, they never ever touch the market ever again. And it's sad. You know why? Because they don't realize what the market can do for you. But they realize the negative parts of the market. The market will take everything you have and also give you everything you ever dreamed of. So you have to pick. What side are you going to choose? So I wanted to wrap that up. That's all I have when it comes to a recap. But I do want to share a personal story. So I think this was 2 or 3 years ago. I lost about $18,000 in one day. Right? About $18,000. Okay. One day. Gone. Absolutely evaporated from my brokerage account like a puff of smoke. Okay. So there's 2 things I could have done. So let's write 2 things. I could have bugged out. Okay. Bugged out. Got to make it back. What else could I have done? Stress. Quit. Okay. All the right things. Or on the contrary, I could have made a plan, journaled. Okay. Just like the things we talk about in the classes. We talk about trade plans, everything like that. Well, planning, it doesn't just come from trades. It can also come from success. So what was my plan? Okay. If I lost 18K in one day, how many days, how many weeks would it take for me to make that back? Doing exactly what I've done. I have all my stats. I have all my data. How do I have all that data? Journaling. So I did is go, that'll take me, let's say, 6 weeks to make back. And just like that, poof, I didn't care about the loss anymore. Because all I did is just have to follow the plan. So if you're in a similar situation and you're brand new to the strategies, brand new to me and PB, I recommend you just make a plan. And also set proper expectations, okay? You're not buying a Lambo your first week, okay? You're not buying a Lambo. You're not getting any rollies, okay? Your first year of trading, you're gonna be buying groceries, okay? Groceries. So I spelled that wrong. That's horrible, okay? So let's say that's like $500 a month, okay? So let's say these are your first 6 months. You buy groceries. 6 to 12 months is rent. Say you live in LA and your rent is $1,000, okay? There's levels to this. Okay, then 12 to 18 months, it's rent and groceries. So now you're making $1,500 or $2K a month. And then 2 years plus, you're making $4K. And then 3 years, you're doing $10, $20K a month. Notice though, I wrote months, not days. A lot of times, traders, they hit a big trade, and what do? They give it all back. Why? Okay, so let's just use MSTR for example. MSTR went absolutely nuclear. Okay, MSCR went crazy. All right. Remember that huge rip it had? Huge rip. Okay. None of the new traders sold it or anything, and they gave it all back on the backside. Same thing with Tesla. Tesla ripped all the way up to 500, and now it's at 410. They gave all that money back. Right? The faster you make money, the faster you will lose it. And it's also, one day we'll do a lesson about this, but when things go up, they come back down much quicker. I think it's a staircase up, elevator down. And that is all I have to talk about today. So quick recap is, if you're down a bunch of money, make a plan, journal it, make sure you don't make those same mistakes again, and keep your seat at the table. That is it. Hopefully you enjoyed the boot camp. I sure as heck had a lot of fun recording this and teaching all of you, and the feedback's been fantastic. So more to come.
Sick. So guys, one other thing I wanted to talk about before this boot camp goes out is probably the number one reason why traders fail. And I've talked about it a lot in the boot camp, but you guys just need to be reminded. You have to. Is you're going to lose in trading. You're going to lose in trading, and that's okay. Losing is the biggest part of winning in trading. But just because you lost money last year, or you're down money in the last 2 months, or things aren't going well, doesn't mean you need to try and make back all your losses like tomorrow's your last ever day ever trading the markets. If you want to be here for the next 5, 10, 15 years trading, then stop trading like today's your last ever day. Stop. Start viewing the market in terms of months, years, even decades. Like, stop looking at such a short term in trading. You need to zoom out. Every single day, you need to start fresh. You need to start like you have a fresh P&L. Your account has, say, your $1,000, exactly $1,000 in it. Like, act like it's a fresh, everything's fresh. Fresh mindset, fresh psychology, fresh P&L. Act like your all-time P&L is zero. Whether you're up or down, act like your all-time P&L is zero. Do that every day. You do that every week, every month, every year. I don't want you, even if you're down $500,000, I don't want you to think that you're down $500,000. I want you to think that you're even, so that you can trade the best. You're not trying to make back your losses. So guys, with that being said, Bootcamp Day 7 has come to an end. I hope you guys enjoyed.